clinging to optimism. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Romaine talks about clinging to optimism. The S&P 500 clinging on to gains. This would mark the first advance this week, this holiday-shortened week. And you are seeing big tech lead the way, with the NASDAQ 100 up 0.9%. The chip sector getting a boost in particular, thanks to TSMC's outlook. We're looking at the two-year yield moving down slightly by 2 basis points. This is, of course, the tenor that is most sensitive to Fed policy. The yield spiked after the jobless claims report this morning, after yesterday surging 14 basis points on hotter than expected retail sales. It's gone from 5.2% in mid-October to as low as 4.1% last week, so all over the place. And finally, we're taking a look at WTI NYMEX crude up by 2.5%, climbing on rising Middle East tensions, with the U.S. striking more than a dozen Houthi missiles, while Pakistan, of course, is carrying out retaliatory strikes in Iran. So a lot to keep track of, Romaine.
All right, but let's go back, of course, to what is actually big move in the market today, and that is a big day once again for, well, big tech. That is the bright spot today, and after a years-long slump in demand for new tech hardware, the latest earnings report that we got out of Taiwan Semiconductor, well, it suggests a recovery for smartphones and computers. The CEO telling investors that TSMC's businesses have bottomed out, and he sees a healthy growth in the year ahead. And it's not just bluster. Just last week, the Semiconductor Industry Association, they estimated that chip sales posted their first monthly increase after more than a year of declines. That is the bright spot, and it's a big reason why you're seeing the NASDAQ 100 outpacing the rest of the market by a factor of at least 4 to 1. And the Philadelphia Semiconductor Index is outpacing the NASDAQ itself by 3 to 1. In fact, chip and chip equipment companies are projected right now to post the biggest year-over-year earnings growth among any other subsector in the tech space. That's according to Bloomberg Intelligence. Of course, a lot will still depend on the economy and, of course, the path of interest rates. But Blackstone CEO Steve Schwarzman, he told Bloomberg earlier he already sees those animal spirits returning to the markets. Now, the case for animal spirits may be bolstered and, well, quite frankly, maybe even tempered just a bit by the unexpected drop in applications for U.S. unemployment benefits. We got that data this morning, and while we always have to include that little asterisk that the weekly jobless claims report tends to be very volatile, the smoothed-out 4-week moving average still confirms the trend, Scarlett, having now dropped to the lowest level in 11 months.
All right, so let's take a look at how that all illustrates out. And the subject line really says it all. U.S. labor strength. The number of people filing for unemployment benefits fell last week to 187,000. That was a number that was below all the estimates in a Bloomberg survey of economists. And by the way, also represents the second lowest reading since the 1960s. So chalk one up, a big one up, for those in the soft landing or no landing camp. Now, when you look at the unadjusted figures, it appears companies are less willing to let go of employees than in the past. We're actually at the seasonally weakest point of the jobless markets. There's always a spike right around January of every year, but since the pandemic, as you see, it's been a series of lower highs. Romaine?
All right, Sonia Meskin joining us right now to help kick things off to the close. She's head of U.S. Macro over at BNY Mellon. Here in Studio 2 with us, Sonia. Great to see you.
Thank you for having me.
Everyone is focused right now on macro conditions. Everyone is focused on the narrative of the Fed cutting rates or maybe just staying the course of where it is right now. You take a look at that trend line in the job market, not just the weekly jobless claims numbers, but all these labor market data points we've gotten. They still seem to suggest a much stronger labor market than the financial markets have given credit for.
Well, yes, I would agree with that characterization. That said, I do think the Fed has done a reasonable job over the last couple of years bringing down demand and, bringing down job openings, for example, without actually unemployment coming up too much, which is consistent with the soft landing story that the markets are pricing right now.
So do we not need to be worried about the potential for a recession this year?
Well, we would think that yes, it's just not actually our central scenario. Our central scenario for the U.S. is a soft landing scenario.
What is the likelihood that inflation will start to pick up in a way that people aren't expecting? I mean, we are, of course, very mindful of the move higher in oil prices and in shipping prices because of exogenous shocks taking place in the Middle East. But what are you hearing, or what are the areas of concern when it comes to other prices moving up?
Sure. Those exogenous shocks, mind you, seem to be never ending in the cycle.
True. It's consistent.
Exactly. But outside of that, I would think, there's definitely around the central scenario that we just discussed of soft landing, the tails definitely appear to be fatter than usual. And one of those is the upside risk that inflation does reaccelerate because the labor market is still strong and because some of those supply side factors that have been weighing on inflation more than we had expected may in fact be waning.
What about the rest of the world? Because Europe is, of course, contending with inflation, so is the UK, and they're looking to cut rates as well at some point as inflation does slow down, but there is that risk, again, of all these supply shocks.
Yeah, we do think that international divergence is one possibility this year for sure. The U.S. was more resilient last year, and so far it appears that that trajectory is intact for 2024.
I am curious. I mean, as we get deeper into earnings season here, there is a lot of optimism about what we're going to see out of those numbers. Certainly on a year-over-year basis, you're going to see some improvement. But even longer term, when you compare it to longer-term trends, it's still a pretty healthy setup, assuming that these numbers do come to fruition here. If that is the case, is there a case to be made of gravitating to a much broader pool of potential stock picks, or do you stay kind of in that big tech, large cap space because that's where the growth is, and more importantly, that's where the safety might be?
I think that's a really, really important question for 2024, and maybe perhaps because I'm an economist, to me it harks back to what the Fed ends up doing, how much they end up cutting, how soon they start cutting, because for those, as we discussed in here before, for those smaller caps, actually credit provision is very important, and they're suffering more from higher rates. So the more the Fed cuts and the sooner the Fed cuts, the more helpful it would be for smaller caps.
Did you always want to be an economist? Was that like a dream of yours when you were a little girl?
Actually, I was born in Russia. And economics in Russia is a very important topic. I remember inflation on a very different scale than we experienced in the last couple of years here. Yeah. So yes, I got interested in it early.
All the hair pulling we've been doing about our brief flirtation with 9% CPI, that's nothing compared to what you saw.
Well, try 25%.
No, how about that?
I know, so this idea of getting back to 2% is, just the scale does not compare.
Well, you know what though, it does come back to expectations. You don't want people starting to buy gold and putting gold bars under their pillow because they don't know what to expect from inflation.
Yeah, that's a really good point. I mean, when it comes to inflation, though, there is this idea, and it goes back to expectations, that things will, as everything normalizes, will go back to a pre-COVID normal, even when it comes to price increases. That's wrong, isn't it? I mean, one of your takes is that people are going to have to adjust that, and it's not necessarily bad for stocks either.
Yes, we would agree with that view because it does seem that structurally things may have changed on the labor market side and on the supply side in general going forward. This could be coming from geopolitical risks that we discussed being elevated, from green energy transition, et cetera. That said, we do have potentially AI-derived productivity gains coming down the pike as well over time. So I think the uncertainty around inflation expectations has risen, and it does appear that market pricing actually reflects that.
All right, Sonia, always great to talk to you. Sonia Meskin helping us kick us off to the close. Head of U.S. Macro over at BNY Mellon. A lot more coming up here on the program, including a closer look at Apple, suffering from 2 downgrades in the last couple of weeks and now getting an upgrade over at Bank of America. The upside from the Vision Pro. We're going to break down all of the recent Apple news with Dan Ives over at Wedbush.
Plus, the chief negotiator of SAG-AFTRA, Duncan Crabtree-Ireland, will be joining us from Davos. He'll share his views on AI and the labor market.
And extreme winter weather right now hitting the Northeast and hitting Amtrak. Dozens of cancellations along the Acela line. We're going to sit down live with the president of Amtrak about the disruptions, the short-term disruptions, as well as some of the long-term issues when it comes to climate change. All that and more coming up in a bit. This is The Close on Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As markets anticipate a dovish pivot by central banks, policymakers grapple with 2 wars on the global stage, and AI continues to dominate the tech headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Continuing coverage this week, only on Bloomberg Television and Radio.
All right, taking a look at shares of Smith Douglas Homes. You may not have heard a whole lot about it, but it's actually one of the biggest IPOs we've had so far this year. Investors welcoming that debut, and maybe it's a sign that the IPO market is finally showing some sort of stability. Having raised $162 million on its first day, Smith Douglas is dispelling fears that it would mirror recent underperformance by some of the IPOs out there. Let's get right to Amy Orr, who helps cover this for us here at Bloomberg News. And we talk about the performance of the secondary IPO market, meaning once those companies come to market. We saw a lot of big names last year, and they had decent debuts. But of course, within the next few days, that sort of luster really waned. I'm curious as to whether there is a different setup now, that the appetite not only for the new issue, but more importantly, the secondary market is going to be there to support a healthy IPO market.
Well, it's a new year, so it's a new page. So asset managers will have like a fresh capital pool to play with. So everyone is eager to actually play with both the primary issuance, but also the secondary issuance as well. So hopefully this is going to be the year where things are going to normalize. But we're seeing a very slow start. As you mentioned, Smith Douglas is the first, which is the largest so far. But right now, Bright Spring is raising money. So that is going to be around $1 billion in stocks, but also there is going to be like mandatory convertibles. That's also like $400 million. So that's going to be big. And also Amer Sports is coming. So like there's a good pipeline that is coming. So hopefully it's going to be a steady flow of IPOs to come, and also in the secondary market.
There's a good pipeline, but as Romain mentions, the performance in the secondary market weighs on people's minds. How are investors feeling about that? How's that playing into whether they're going to take a flyer on any of these names?
I kind of feel like everyone is thinking about 2023 kind of class of IPOs almost as a anomaly, and also it's kind of like it's in the back burner now, so everyone is looking forward. So hopefully this year is going to be better, and everyone is like looking at the comparison between the performance of IPOs last year compared to the broad market rally, especially when we see the S&P has rallied so much, the Nasdaq has rallied a lot more. So essentially, when you think about putting money to IPOs, they want to actually have that boost, and not only just a tiny boost, but also like outperformance. So if the market, so if they don't do that, so it's kind of hard. But right now the market is going for the slow and steady first, because at the end of the day, the IPO market is very jittery. So everyone wants the sentiment to actually kind of build up to the point that they can actually get riskier tech companies to come. So that's the reason why right now all the home builders, like the people or the companies that have like strong...
Well, that's what I'm curious about too. I mean, because Smith Douglas, I mean, no offense to them, it's not quite a household name. But then some of the household names, I was just taking a look at Birkenstock, which everyone knew. That's now trading back below its IPO price. It gets to the question as to what's the quality, the potential quality of the companies that could potentially come to market. Are we talking about companies that are going to already have profits and have a growth story, or is this buy it now and wait for 4 or 5 years until it becomes actually profitable?
I think Birkenstock is also a very interesting case where a lot of people are thinking about it as in like whether it's overpriced in a way, because right now like it's actually doing pretty well. I think it was up like 8% or so. So even though like today it's kind of come down slightly, but essentially right now is everything is larger size, so that all the bigger asset managers can participate. Definitely profitable, or with a sight to profitability. Those are the ones that people have confidence to put money to. This is not the time to put anything that is risky to put to the market at the moment, to test the market.
So just comfortable shoes, no? Unless there's like an AI. So, I mean, Scarlett bought like 20 pairs of these. That didn't even move the share price. So I don't know what more we can do.
She's holding up, buoying the share price. It's not going further down just because of her.
To be fair, Birkenstock is now forecasting revenue of 18%. It's just that people expected a lot more than 18% given where the stock was priced. All right, Amy Orr, thank you so much. Amy Orr covering IPOs for us and leading that coverage. All right, coming up here on The Close, more conversations from the World Economic Forum in Davos. We're going to hear from the new CEO of Morgan Stanley, Ted Pick, about M&A and the Fed's path for interest rates. This is The Close.
All right, when it comes to mergers and acquisitions, Morgan Stanley CEO Ted Pick says his firm has enough organic growth without it. He shared his thoughts with the hosts of Bloomberg Surveillance out at Davos at the World Economic Forum.
Stuff is going to come across the transom. I'm not sure we need to be in a rush because, again, we don't have sort of the victory's curse of thinking we just sort of do these things. I think there's enough organically, but I'm glad you mentioned, Lisa, because I think when you're talking about 5 or 10 years and you think about the amount of aggregation and transparency of wealth outside the U.S., particularly in Asia, We're 22% owned by our friends at Mitsubishi, who literally saved us during the financial crisis. I've been going a lot to Japan. I go every quarter. We've doubled down on Japan. Imagine, just as sort of like a vision thought, imagine wealth in Japan 5 to 10 years from now when you come off the zero rate, the zero barrier, asset allocation, wealth opportunity, investment banking. It's one example of the kind of place where we could do extraordinary business.
We had a bank CEO earlier this week who just said it out loud. Investment banking's been in recession for the last couple of years. It's been really, really tough. Can that end without rate cuts from the Federal Reserve? Can we end that IB recession given what you see in the pipeline?
I hear you guys talk about this every morning. And once in a while I say, we don't know. Who knows? I think the path is probably that inflation is past. But, there's a tail. There's a 5 or 10% probability they do 50 in March. Not talking 25, 50, 5 to 10%, right? It's 40 to 60% they do 25 in March. There's also, if you price an exotic, 5 to 10% possibility that we have another hike in us. I kind of did that check thinking of you two guys because it is possible that we either, because every time the Fed talks about it, right, as they did in the reverse in the teens, it tightened up and they didn't go. Now they talk about it, loosens up. It's like, okay, we don't want to have the Arthur Burns bit. We don't want it to get away from us. So we're gonna do it when we're ready. I think the big picture though is they're gonna start lowering at some point when they're ready. They're gonna be prudent. They're gonna be thoughtful. And that kind of predictability is very good for the core investment banking business because you have these financial sponsor portfolios that have been locked up that need to be liberated. Some can go in continuation funds, some can go to other sponsors, but some have to go public or be sold. And then the corporate dynamic was folks are ready to get going then with 3 years of pandemic. There's always going to be an election, there's always going to be macro, but I think the core investment banking activity that we have known with real cost of capital, traditional corporate finance like the mid-90s, I think it's going to come back.
That was Morgan Stanley's new CEO, Ted Pick. We want to continue the discussion on banks, broaden it out to the overall banking sector with David Traynor now. He is CEO of New Constructs. And David, I look at the KBW Bank Index, and it fell 4.8% last year. It has a trailing PE of 9.45. And in terms of the members that gained last year, the big banks are there. JP Morgan Chase, Wells Fargo, Citi, each gaining at least 20%. What's priced into bank stocks right now as we think through the various scenarios that could play out this year?
It depends on which bank stock you're talking about. If we're talking about JP Morgan, we're showing a stock that implies a permanent decline in profit around 20, 30%. So there's a lot of upside if market expectations just believe or just get to the place where JP Morgan maintains its existing level of profitability. You can't say that about Citi or Wells Fargo. You can say that about some of the smaller banks. Zions is one of our favorites. It's also priced for permanent profit decline. So I think the answer, unfortunately, is not that easy. It depends on which bank you're talking about.
Absolutely. And JP Morgan Chase, by the way, is your favorite stock in the financial sector. What's more likely to happen, do you think, David? JP Morgan losing some of its shine or the other big banks closing the gap with it, improving?
I think it's probably more the other banks closing the gap a little bit because they've really been stumbling around for a long time. I mean, how many more scandals can we expect from Wells Fargo? How deep does that rabbit hole go? And when do they start kind of getting their act together? And we've seen Citi. Citi's actually shown some serious improvement already in getting its act together. They've got, they know what act to follow. So I think it's only a matter of time for those banks to catch up. And their valuations imply that they will. It's really just surprising to us that the valuation of JP Morgan remains so cheap.
Yeah, and I'm sure Jamie Dimon has pretty much made that clear, as he did on the conference call. He also thinks it's a little cheap as well. It gets to the question, though, when we talk about the competition between these banks. I know we all sort of lump them in, at least the big five, all kind of together, but they all seem to be kind of, to a certain extent, either deliberately or maybe inadvertently moving in different directions in terms of the strategy, in terms of the type of businesses they're chasing here. Is there an argument to be made that the traditional financial bank, big money center bank as we know it, that model may not be long for these days?
I think it's more possible that the regional banks are going to kind of be sort of phased out as they just can't keep up on the scale front. But the big money center bank, I just don't see it going away. I mean, there are a lot of new technologies have been sort of threatening the legacy financial system structure for a while, but not a lot of that has come to fruition. we've been saying for a long time, we think it's more likely that the big banks adopt those technologies and incorporate them and use them to their advantage. They've certainly got the war chest to go and buy those technologies or buy the firms that are creating those technologies and put them to use. We think that's more likely. At the end of the day, Romaine, I think it comes back to distribution. And these big banks just have that distribution that is effectively almost impossible for the smaller ones to try and replicate. And at the end of the day, it's the distribution that matters.
Okay, well, then I'll flip that question around then back to the regional side of it here. As to basically, do we have too many of those smaller and regional banks? Is there a consolidation, meaning do they get folded into other banks, or do they just wither on the vine and eventually disappear?
I think you're going to see the weaker players kind of disappear and fall out. And that may mean some cheap acquisitions for the stronger players. So there'll be some consolidation because, as it is with most companies, even if it's not going to survive, there's some good parts, even if the bad parts outweigh the good parts, and someone will come along and pick up the pieces. As we've seen some of the bigger banks do over the years as well. I mean, JP Morgan has certainly been the beneficiary of taking some other financial firms out of receivership and getting assets for pennies on the dollar. I think we're going to see more of that, but ultimately I think it leads to where the bigger firms and the bigger scale are the ones that are left standing.
David, we mentioned how JP Morgan Chase is your favorite financial stock. What within the regional banking space is your favorite name?
Zions. That's the one we've liked for a while. We think that they've got among the strongest balance sheets, highest level of profitability, highest margins, not a lot of concentration in commercial real estate, which is great, and then a really cheap valuation. I mean, the valuation for Zions, I think, implies something like a permanent 40 or 50, maybe 60% decline in profits. So it's really priced effectively to go out of business almost. And so we think that that's good risk reward.
All right, David, always great to talk to you. David Traynor, CEO over at New Constructs, a breakdown here of some of what we've seen in the bank. And really, I'm really much more fascinated, Scarlett, by this idea of sort of what our banking sector, at least here in the U.S., is going to look like, 10 or 20 years down the road. Is it going to basically be we're going to have no options other than Chase and Citibank, or are we going to have a broader array of regional and smaller banks? And I mean, we're kind of the same generation. I mean, those banks, at least where I grew up, they were huge. I mean, if you were a small business or a medium-sized business, you weren't getting a loan from a big money center bank. You had to go to the regionals.
Absolutely. They had the presence, in your neighborhood. They had the connection with you that the big banks weren't interested in doing. And you can make the argument that a bank like Citibank is moving away from that. They're closing down, and they're really focusing on some of the more wholesale businesses.
Yeah, and they've made that clear. But what happens if you also start to see maybe JP Morgan gravitate away from that? And the others, who's that left with? Are we just going to be left with Wells Fargo?
And Bank of America.
And maybe some of the super regionals?
Yeah. That may very well be the case.
All right. Well, that would potentially give us something to talk about for the next few years, Scarlett Fu. But at least for the next couple of hours, we're going to continue to focus on the markets. Stick with us here. We're going to break down some of the action in the commodity space when we come back after the break. Romaine Bostick alongside Scarlett Fu. This is The Close on Bloomberg. This is the countdown to the close, just about 2:30 here in New York. Green across the screen for the equity space, and quite a bit of green going on in commodities as well. Let's get right to Abigail Doolittle, who's standing by with our commodities close. Abigail.
Indeed, Romaine and Scarlett, we do have some green on the screen for commodities. Near session highs, the Bloomberg Commodity Index about 0.5%. New York crude, you can see up 2.1% on continued and heightened tensions in the Middle East. Heating oil futures, not surprisingly, higher, up 1.5%. In fact, most of the energy complex is higher, but heating oil futures, I say that because of the cold weather here in the U.S. Gold futures up about 0.8%. Wheat reversing a decline from earlier, now up about 0.3%. There are two exceptions. One of them, though, to this green on the screen, one of them is natural gas. We, in fact, have natural gas down for, I believe it is a third day in a row, yes, three down days. And you can see it's a pretty significant decline, almost a bear market in 3 days. Now, of course, natural gas is wildly volatile. Part of this decline has to do with the likely delay in the startup of the Golden Pass LNG terminal. It could mean a drop in gas demand and increased storage volume. Speaking of that, Romaine, inventories today, they were more than expected. The withdrawal was less than expected. Stockpiles are basically at above the 5-year average.
All right, our thanks there to Abigail Doolittle. A check on what's going on in the commodities space. Let's go back, I guess, to the labor market and all of the issues that have battered it around. Out there in Davos, our next guest is fresh off a panel entitled Workers in focus, and he should know. Duncan Crabtree-Ireland is head of the SAG-AFTRA union. He's the national executive director, and he was the chief negotiator in that union's labor negotiations with Hollywood studios. In fact, he was really at the center of what was probably one of the most widespread spate of labor strikes that we've seen in this country in several decades. Duncan, great to have you here on the program. And coming out of, I guess, the resolution of those strikes, the new deals that were struck, if you will, are your members, those 160,000 plus members in the film, television, news industry, are they in a better place now than where they were before those negotiations started?
Thanks for having me, Romaine and Scarlett. It's absolutely, the answer to that is yes. Our members are in a much better place in a whole number of ways, economically, in terms of significant changes to the structure of the industry that we were able to negotiate for and ultimately achieve, and of course, with respect to AI. And there were no protections with respect to the use of AI in our contract with the studios and streamers prior to this round of bargaining. And now we have 16 pages of detailed protections that I think put our members in a much better place. It's not the end of the process.
Yeah.
It is going to evolve. There will have to be and will be more negotiations in 2.5 years, but it is a really important and real starting point that's very protective.
Well, that's what I'm curious about too. I mean, those 16 pages, we know how fast technology moves, particularly when it comes to AI and all the iterations of it. There are a lot of folks on other stages at Davos talking just about that here. How relevant are those 16 pages going to be, I don't know, a year from now, let alone 2.5 years?
Yeah, no, I think they will be, because we anticipate, we've anticipated this. We've been working on AI for a number of years, and what we knew is we had to embed the core philosophy that underlies fair treatment in this area. And that core philosophy was informed consent and fair compensation. And so while there are a number of mechanisms that are built into the contract to actually implement and enforce that, those principles will continue on regardless of newly developing technology or changes in industry practices. I also think that while the technology continues to advance very rapidly, implementation in the industry is going to follow at a slightly slower pace. And part of this contract is every 6 months we meet with each of these studios to find out exactly what they are doing and what they plan to do, especially with generative AI, so that we have that information in hand and ready to go for continued bargaining over future contract terms.
That's really interesting, the fact that you'll be meeting with them regularly every 6 months. Do you believe that the trust is there on both sides, given the somewhat acrimonious relationship that the two sides had during the strike?
It was a difficult time during the strike. There's no doubt about it. I think that things got way more adversarial than it should have been. We should have been able to achieve these provisions without having to go on strike. But it is true that it took a strike in order to accomplish it. Having said that, I think we are eager to move forward together in good faith, based on the agreements that we've reached. Obviously, we'll be using our enforcement powers to ensure that those contract terms are lived up to. But my expectation is that now, with those ground rules set, that we will see compliance with those rules and that we will be able to work together to move forward in a way that is more human-centered and that's supportive of creative talent.
And we should mention that the Screen Actors Guild recently signed a deal requiring consents and guaranteed minimum payments when your members' voices are used or replicated digitally in video games and other entertainment. Can you tell us a little bit more about how that might kind of form the template for other future deals?
Yeah, no, I appreciate you asking about that, Scarlett. First of all, let me just be clear. We are in the middle of negotiations with all the major video game studios, and this is not them. We are eager to reach a deal with them. We haven't got there yet. We have a strike authorization. I'm hopeful we'll be able to make a deal. But this was a deal with a new AI company called Replica Studios that specifically is focused on using AI technology to create digital voice replicas. And the reason why this deal is so important is, first of all, it builds on the AI principles that we embedded in the studio and streamer agreement that we were just talking about. And not only that, this is a company that's focused in this area. It's made up of AI professionals and people who have that kind of technical skill. And they have concluded that they can, in fact, approach this with a sense of ethics and a sense of support for creative talent. So there are provisions in this agreement that I think will be the model for future agreements, including things like enhanced transparency, safe storage provisions with respect to the biometric data and data from the digital replication process, as well as time limitations on the use of these replicas. So I think there's a lot to like about that agreement, and it is a step forward in the evolution of these protections.
All right, we'll be looking for other agreements similar similar to this then. Duncan, really appreciate your joining us. Duncan Crabtree-Ireland is the SAG-AFTRA National Executive Director and Chief Negotiator. He, of course, played a critical role in helping actors get paid more. And Romain, you know who else is getting paid more? According to Walmart, store managers are going to get paid more.
Yeah.
Their base pay is going up.
Yeah, I mean, this is a big deal. I remember they raised the base pay last year for store managers to, in some cases, 6 figures. They're now also saying that there will potentially be performance bonuses that could be as much as 200% of your base pay here. And we talk about, what a retail worker would make. And whether you're a manager or whether you're down the line here, the amount of money that you could potentially make in that space today is significantly greater than what it was, I don't know, a year or two ago, particularly at Walmart.
And especially because Walmart does kind of set the tone. Obviously, not every retailer has the same kind of scale that Walmart does, but because there's such a fight for talent, this is going to be an issue. We should mention that the base pay for store manager wages goes from $117,000 to $128,000.
Yeah, and it's interesting too because this also feeds into the whole notion of inflation and the Fed's fight against it. Remember, they've been so tapped into wage growth here, and it's not over, right? We all kind of thought we were past this, but I think this Walmart, so I know it's just one company, but it seems to suggest that a lot of these companies still need to offer a little bit more to their employees to keep them
It's the biggest employer in the U.S., so there you go.
Absolutely. And of course, as they do, a lot of their competitors will do as well. Stick with us. We'll be back in a moment. This is Bloomberg. All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Hertz, an upgrade today to overweight over at Morgan Stanley. Analyst Adam Jonas impressed with the decisive action the car rental company has been taking to address what he calls self-inflicted challenges from that large EV fleet. Jonas says the current share price is an invitation for investors who can stomach elevated levels of volatility. Those shares getting bought up today by about 8% here on the day. Next up, let's take a look at Pinterest, nailing it with an upgrade to buy over at Argus Research. Argus saying improvements in content and personalization, as well as Pinterest's deal with Amazon, will all drive higher engagement, increase ad prices, and ultimately supercharge growth. Those shares up 2% on the day. And finally, let's take a look at Apple. Back in Bank of America's good graces, snagging an upgrade today to buy from hold. The iPhone maker set to begin taking orders for the Vision Pro headset this Friday. And analysts over at Bank of America expect the mixed reality device will actually give a boost to both hardware and services revenue, and says that the AI features baked into that are poised to be expanded into the iPhone, which should drive a stronger upgrade cycle for the handset. Shares of Apple having a phenomenal day, up 3.5%. And those are some of our top calls. We do want to stick on Apple here and go out to Dan Ives, a senior equity analyst over at Wedbush. He's got an outperform rating on the stock. And let's get his view here on, I guess, what is going to be the next big new thing for Apple, at least if Tim Cook has his way. That mixed reality headset set to start, I guess, taking orders this Friday. Not quite sure exactly when you get your hands on it. But do you expect to see any sort of a material impact once we get the next earnings results in the following quarter from the release?
Yeah, look, this is laying the groundwork for the next form factor. And if you look at Vision Pro 2 years from now, we think it's going to resemble sunglasses and be less than $1,500. And it's all about tapping the install base. Developers are the key here. This is something I think the street's missing in terms of what this is ultimately going to lead to. We believe an AI app store announcement over the next year.
I am curious. I mean, in addition to the release of this, and I've already encountered some people wearing those new Meta, Ray-Ban glasses or whatever you call them. Is this kind of, we went through this before with Snap and of course with Facebook a few years ago, and it really didn't gain any traction. Is this sort of the moment now where these types of wearables on your face are actually going to have a little bit more traction for the consumer this time around?
Well, and of course, when Apple talks, everyone listens. I mean, you're talking about 2 billion iOS devices, 1.2 billion iPhones. It's all about the apps. And when you look at why they waited so long, it was about getting the sort of content providers, the partnerships, and the apps where this is going to now start to be part of the vision. And I think it's going to form into something that's much more mass market over the coming years. And that's why betting against Apple, it's been the wrong move, right? It's betting against Tom Brady in a Super Bowl.
All right. Well, Bill Belichick knows a little thing or two about that. Let's move on to Apple's dispute with Massimo, the patent dispute, because we, of course, found out this week that a court ruled that Apple has to stop selling the watches with the oxygen measurement feature while an appeal of the ban plays out. And, of course, that could take a while. We heard from Massimo's CEO on Bloomberg Technology today. Take a listen to what he had to say.
Apple knew their product wasn't good enough to be relied on medically, but literally they said, and this was in 2020, in the chaos of COVID, this is quotation in their document, if we launch pulse oximetry with our watch, we'll gain market share from Fitbit.
If true, not a great look for Apple. I'm curious from you, Apple doesn't break out sales or numbers related to Apple Watch. It's just part of the wearables business, which I believe made up about 10% of revenue in 2023. Ultimately, how important is this dispute on Apple Watch to its bottom line, to the financials?
Look, I think this is something that's going to head towards some sort of settlement or compromise out of court. Because, look, Apple can't keep having these starts and stops. It is important to the broader vision in terms of where the watch is going and the broader ecosystem. And these patent issues, obviously it's not just the first one. I think you're going to see more of them. And it's something Apple's going to have to deal with. But as we've seen with Cupertino, I think it's a small bump in the road. And ultimately, 3 to 6 months from now, it's a non-event.
All right, Dan, always great to talk to you. Dan Ives over at Woodbush, a closer look at Apple. Apple having a phenomenal day, up more than 3% here, getting a bit of its mojo back. All right, coming up here on the program, we're going to have a discussion here with Roger Harris. He's the president of Amtrak, the big rail system here in the United States. He's going to discuss some of the train disruptions that we're seeing because of the winter storms now sweeping the Northeast. Also going to give his take on some of the longer-term challenges here for the train service as well. That conversation coming up next on The Close. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. David Weston, the host of Wall Street Week, joins us as he does every day around this time. A focus today, David, on transportation here in the Northeast, actually in huge parts of the United States right now. We're under some extreme cold weather, and it's really started to disrupt travel, planes, trains, and automobiles.
I only know my little part coming in from Westchester. It has been a pain in the neck the last 2 days because it is very, very cold. Yeah. But you know who also has had a lot of trouble? People who are trying to take the Acela on the Northeast corridor between Washington and Boston. They've had to cancel a lot of those trains because of the cold weather, in fact, which surprised me, actually.
Yeah, I'm always amazed at how, I guess, Amtrak deals with that. I mean, obviously we know weather is a big factor. Just obviously you have those rails on the ground. But like, how do they sort of create sort of a template for dealing with that and dealing with it efficiently in order to get those trains back up and running?
And as we all know, they've had their challenges. We haven't invested in this country enough probably in rail for some time. Now we've got climate change coming in. So it's not going to get better, Romaine. I think it's going to get worse.
I was looking at sort of where Amtrak is located. I mean, they're actual rail lines. And of course, here in the United States, we have a huge swath of that Northeast corridor, as well as those southern lines that are going basically right along waterways. The similar thing out in California. And those waterways the tracks are sometimes very close to the waterways.
So let's turn to somebody who actually knows this stuff terribly well. He's Roger Harris. He's the Amtrak president. So Mr. Harris, thank you so much for being with us. We've just been talking about this. I know you had really increased use of of Amtrak last year. Congratulations on that. At the same time, we do have these problems now with weather today. Could you tell us what's going on with the Acela and why we've got a problem with it?
Okay, thanks, David. Pleasure to be here today. So yes, you were talking about the problems we have with water and weather, and it's certainly true that some of the tracks are close to shorelines, which was a problem a few days ago. And also the cold weather we've been experiencing this week has been a problem, especially with the older Acelas, which we're hoping to replace with the new ones coming later this year. But we want to make sure we run a very reliable service, so we have proactively canceled some services so that the ones that do remain are reliable.
And I know you have some ambitious plans for Amtrak. Could you tell us what you need to get in order to be able to do this? I know some billions of dollars have actually been committed just this year, both for bullet trains and also for that Northeast corridor.
Yeah, so really exciting. We from the IIJA, we had essentially enough money to replace our entire fleet over the next decade, and the new sellers are going to be part of that coming up this year. And also, we have about $20 billion worth of projects between Newark, New Jersey, and New Rochelle, New York, that will, in the coming decade, mean the replacement or renovation of 8 tunnels and 4 or 5 bridges along that 25-mile segment.
So looking at long term, though, I mean, as you try to sort of grow this business, and it is a business, is this an increase in ridership along existing lines, or is there somewhere else outside of sort of the more profitable Northeast corridor or some of the lines you have out in California where you can see an increase in ridership?
Sure, absolutely. Great question. It's really both. So our ambition is to double our ridership to 66 million riders a year by 2040, and that really comes in equal measure between growing the Northeast Corridor service, which we just spoke about, doubling that itself, and that involves some of this new infrastructure that I just mentioned, and also more rolling stock, some of those new trains that were paid for by the IIJA. But it also is going to mean expanding service to new markets. Some of those were funded in the recent Fed State awards that the FRA announced, including programs in California, as you mentioned, and also some really exciting ones closer to home in Virginia and North Carolina.
But when you say sort of expanding the infrastructure, because when I hear doubling the number of passengers, I think about not just the general infrastructure of Amtrak, but some of those choke points, of course, getting in and out of New York. I mean, you can have smooth sailing in, the 50 miles or so before you get here, but then when you get to that last mile, you're talking about, having the right of way and something that you don't always have, particularly down there in D.C. as well. So how do you address that? Is that an infrastructure problem, or is that more of a political problem in dealing with the jurisdictions to get something opened up?
Well, certainly it takes a long time to get everybody to agree to all portions of the projects, but you're beginning to see real results of the infrastructure bill and the funding that came from that and previous work. So, for instance, as you leave New York going towards Washington, D.C. today, as soon as you come out of the tunnel underneath the Hudson, you see this enormous bridge going up on your right-hand side, which is the new Portal North Bridge that New Jersey Transit is developing together with us. And you'll see that we're well underway. We're about 40% finished with the new structure. And that's a great example of where additional capacity will be brought to bear and increased reliability so that we can run more trains and bigger trains through that area, which will help the growth cause.
Roger, I'm curious about what metrics you follow to determine whether your service is improving or not. For example, with airlines, when we fly, there's on-time arrivals. Do you track that sort of thing for Amtrak? Where are you on that, and is it improving?
Absolutely. I mean, I track 4 big numbers. One is revenue, which is always important because we're under a mandate to make the best use of the taxpayers' money and also pay for as much of our operation as is feasible. I track ridership, which is a very important part, another important part of utility and public benefit. And that's the thing that really has snapped back. We grew almost 25% year over year. And actually, we're back to pre-pandemic levels in a lot of the country and even higher than that on Northeast regional services. We look at customer on-time performance, so not really sort of when did the train physically arrive at its terminal, because it often doesn't have many people on board by the time it arrives at the last station. But we really look at the on-time performance of the typical customer on the system. And then we also look very closely at customer satisfaction. So we have a very elaborate customer satisfaction survey process. We also have a lot of work that we do on analyzing the data we get from those customers to figure out where the pain points are, what we can do about them. And the really interesting thing is that you can have 2 customers on 2 different trains with things like on-time performance that look very similar, but their satisfaction is very different. So we're really mining that data today to figure out how we can make the experience as good as possible for the customer.
Roger, this has been very helpful. Thank you so much for your time. That's Roger Harris. He's the president of Amtrak. And I know both of us use this Northeast corridor, and so we're rooting for him.
Absolutely. I mean, in a lot of ways, it could be more efficient than flying if everything is working as it's supposed to work. And I think the bigger issue, too, becomes those choke points, too, right? Because like I said, I mean, you have smooth sailing for so long, and then you get closer to the
It drives you nuts. You think you're going to get there, and then all of a sudden it slows down. That's right. Okay, tomorrow on Wall Street Week, we're going to be joined by Larry Summers. He, of course, is the former U.S. Treasury Secretary. And also we'll talk with Blair Efron of Centerview Partners. That's coming up Friday at 6 p.m. Eastern Time, Romaine.
And you can check David out every day around this time here on our Wall Street Week daily segment, or at least for one more day, as we round out into the final hour of trading here on the close. Stocks actually trying to rebound here after a couple of days of losses. We'll have a full breakdown for you of all the market action when we come back after the break. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostic.
And I'm Scarlett Fu, and it looks like
that picture outside. It looks so deceptive, right? Like it looks nice and warm.
I know, it's anything but.
It's literally like 2 degrees.
I was outside at about 10 a.m. and I was dying.
Yeah, but you made it in okay.
But
right?
I made it in
With
okay.
all your fingers and toes?
Yes,
Yeah.
absolutely. And if you look at the markets right now, you know, it's recovered from 2 days of losses. A lot of green on the screen. Yeah, I mean, it's interesting rebound. And we should point out, I mean, look, this is not sort of the big conviction rally that I think people want to see. But you talk about a big 1% gain on the NASDAQ 100, 1.4% to be sure here. I give you some sense here of where investors' heads are at here. It's not back into those cyclical names. It's into the big cap tech names. The Philadelphia Semiconductor Index, of course, outpacing everything, up by 3%. And that was because TSMC, I think, kind of saved the day, right? Yeah.
They basically came out and said, look, all the pain we've been seeing in the tech hardware space, that at least in their view, that's reached a bottom.
Yeah, they see growth in 2024, and as a bellwether, as a chip maker to NVIDIA and Apple, this was great news for the chip ecosystem.
Yeah, I was taking a look at a couple other indices too, particularly if you flip up the board here, that track a lot of the Asian chip makers and chip equipment companies here, including the Bloomberg Asia Pacific Semiconductors Index, as well as the FactSet China Semiconductor Index here. So this includes Taiwan Semi, SK Hynix, Disco, Samsung, those names like that there. I don't know if we have the chart here, but we talk about the underperformance that we've seen in a lot of those names relative to the broader markets in Asia, as well as the broader markets worldwide. Now, maybe potentially you're going to start to see a rebound in that space. Time will tell. And of course, ultimately, it's not going to be about what TSMC says or what SK Hynix would say. It's going to be about what Apple says. It's going to be about what, the car companies say. Basically, the companies that basically make the final product, they're the ones who are going to determine the path.
And how much demand there is from consumers,
are you
particularly
buy one
U.S.
of these
consumers.
headsets, these Apple
No.
Pro
Not into that thing.
No?
No,
Okay, yeah.
not an early adopter when it comes to technology. Someone else has to be the guinea pig, and then, maybe I'll sign on.
No, okay.
I'm not into that.
All right, there's got to be some individual movers out there, right?
Yeah, absolutely. Let's talk about some M&A in the home builder space. You have MDC soaring right now because Japanese builder Sekisui House is buying it for $63 a share in cash. That's a 19% premium to its last close. Sekisui actually now is the number 5 home builder in the U.S.
Yeah, I saw this is a pretty interesting deal here. I don't know how this is going to be received longer term by investors here, but interesting move. What else is moving today?
Humana, and it's dragging down the health insurance space.
I was kind of surprised by this. I mean, the numbers were just awful.
Yeah, but rising medical costs is not a surprise if you've been to the doctor lately.
Okay, yeah, but I thought they were passing that on to, us.
Apparently, they're eating some of it.
Some of the costs.
They are, apparently, yeah.
Yeah.
You can see Humana down more than 9%, down as much as 13%. It pre-announced, so the official report doesn't come out till January 25th, but you see all the other health insurers falling in sympathy.
You got any bright spots today?
Yes, well, actually, no, I don't.
Oh.
Birkenstock.
Oh.
But I had to bring it in because I have like 40 pairs
What's going on? They're down, only 8%.
Yeah, only 8%. Well, they did have their first earnings report as a public company. Revenue may grow 18%, but clearly investors wanted more.
Back below its IPO price as we move closer to the closing bell. Stick with us. Our coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio originals, our partnership with those folks streaming on YouTube. And Well, no halo behind Tim, but a relatively bright day right now
Not
in
yet.
U.S. equity markets.
Not yet, yeah.
Yeah, definitely, right? The bull's in charge, it feels like, and it really feels like in the last 60 minutes or so, we really got a move to the upside. Having said that, jams, jellies, and gummies are on our mind on this Thursday.
Okay, I don't know where this is going.
Slow your roll when it comes to gummies, everybody. First up, we're going to talk about J.M. Smucker. This story, actually, Tim, it came on his radar. Our own team, Joe Constance, reporting. She got like 5 minutes. She does this series. But talked with the head, the CEO of Smucker, Mark Smucker. He's, I think, 5th generation of the family to run the company.
Is he related to the original?
I think it's, I think his parents just knew that he was destined to take this job.
Okay.
So that's how it worked out.
Smucker.
Yeah.
All right, anyway, he's talking about core weeks for his employees. So basically, you can be in the office every other week doing like a Tuesday to Thursday.
Really?
Yeah, this is pretty cool.
Pretty cool, right?
And it's
Working
actually
in the office 3 days out of 10 days?
Yeah.
That's right. And you work remotely on Mondays and Fridays, and then the non-core
I'm
weeks.
stunned.
You can actually live anywhere in the country you want. It's on your dime to get to the corporate offices, which are just outside of Cleveland, Ohio. But you'd only have to do that a couple times a month.
Okay.
And he says it's working out really well. He says it's working really well
Been a
for
success, right?
retention and attracting employees.
And other companies are contacting him.
That's what I thought
to
was
hear
really
more.
interesting. Yeah, he said, look, there's a difference between what we do and, what the big banks are doing. And he mentioned Jamie Dimon and David Solomon and their return to work. He said, it's not a one-size-fits-all approach, but it's working for us.
Do you want to put it in the suggestion box?
Well, I don't know. Maybe I'll use this as an opportunity to announce my departure from Bloomberg News. I'll be joining J.M. Smucker as the new host of their Jam and Jelly countdown segment.
Well, let's talk about gummies too, because that's
Right
a
up
perfect
against your
segue.
show.
I know
3 to 5.
Romain is a big fan of gummy candy because I've seen him eat it during breaks.
Does he really?
Yes, totally. He snuck a couple in. Bloomberg visited
My wife watches
Haribo's.
the show,
Didn't know that.
That's supposed to eat those.
That's the
Learning
secret.
something new.
Yes.
I don't. Scarlett's lying. I
No,
tell you
no.
honest.
She never lies.
Bloomberg visited Haribo's first production plant in Wisconsin to make their gold bears, their gummy bears. The video is fascinating, but this is also my favorite candy, so I loved
This is a hard day for me because first I learned that J.M. Smucker has this great policy, and now I learned that we sent one of our reporters out to the Haribo
And it wasn't
factory,
you.
and it wasn't me here. What am I here for? Don't answer that, girl.
What I learned in this is that the flavors, we know that they always have different colored gummy bears, but the flavors are raspberry red, lemon yellow, orange, pineapple white, and strawberry green. The green is strawberry, guys.
Yeah, this is great. So I as soon as I saw this story, I sent because it has nice animation in it.
Yeah.
I sent it to my son to see how these things. I never really knew how these things were made. I guess it kind of makes sense. They would have a mold and everything else. But there's a whole debate now in our household as to whether the flavors are really different or whether this is like Fruit Loops, where we all found out that all the different colors are the same flavor.
We're speaking to Dina Shanker a little bit later in the program. That's a question I'm going to ask her. I'm also going to ask how many gummy bears died in the production of this story. Because
they make 60 million every day.
Yeah, it's pretty amazing.
No chip.
There's also
no semiconductor.
Regional differences with what people like in different parts of the world. So it
Wait,
turns
regional
out,
differences in gummy bears or candy? Or gummy candy?
in types of the gummies, so not gummy bears necessarily, but here in America we're not huge fans of licorice apparently.
Can I tell you, Tim spent a lot of time reading this one today.
Yeah.
I got into it.
But it's good. And if you ever
It is
go,
good.
like there's a couple stores that we were talking a little bit earlier. There's a great place in Washington, D.C. that has basically all the flavors that they make. And you get all those crazy ones from different parts of the world that they don't normally sell here. So you get a sense here.
They're
of,
true German
different
gummy,
tastes.
right?
Yeah, but a lot of them have less sugar and other things like that. So you're like, give me the
Wait, they
good
loaded them up with
old-fashioned
sugar to
Do you guys know
American.
why it's called Haribo?
No.
It's a portmanteau of the founder's name and then the town where it was founded, Bonn, Germany.
Oh.
Yeah.
That's good to know.
There you go.
It's the only gummy bear brand I'll eat.
Are you done?
I'm done.
Okay.
I'm just going to
Carol,
say,
are you done?
we have like a million guests on the show, and this one, I think you spent
Yeah, I spent most of my day
most of his
spent most of your day
day
thinking about
reading
preparing
this
for
one
that.
and planning for it. With good reason. It's a
Again,
great
more
read.
behind the scenes that people don't need to know about.
Right.
All right, good stuff, guys. We're going to be back in less than an hour's time. Wrap up the Thursday trading day. Join us on radio, TV, YouTube, Bloomberg Originals, our cross-platform. We call it Beyond the Bell. We'll see you at 4 p.m. Wall Street time.
And we continue our coverage right here on Bloomberg Television to refocus right now on Washington and, of course, some of the disagreements over how to move forward with the U.S. budget. We just learned that the U.S. Senate did pass a temporary spending bill to avert a partial government shutdown this weekend. That bill now has to go to the House, where it is on track to clear the chamber later today. At least that's what the teleprompter tells me. What does Kayleigh Lyons tell me? She's the co-host of Balance of Power. Kayleigh, I mean, the House is not the Senate, as we know. The dynamics there are much different. How much confidence do we have right now that this will make it through the House and to the president's desk?
It seems the confidence is high that this continuing resolution, another stopgap two-step measure that will continue to fund the government through March 1st and March 8th, respectively, depending on what program you're talking about, will pass the House under a suspension of the rules, which means it's going to require a 2/3 majority. That means Democrats are going to be needed to carry this over the finish line, as there are likely many House conservative members who will not be voting for this package, either because they are opposed to another continuing resolution or because border security measures aren't attached to it. Just earlier today, some members of the House Freedom Caucus were attempting to push House Speaker Mike Johnson to include border measures in this continuing resolution. He is not doing that. It is going forward as the Senate has set it out. Again, the Senate has passed this. The House is expected to take it up this afternoon so everyone can get out of town here in Washington before a snowstorm come Friday. One thing I would point out, this does kick the can down the road for a third time. And when we get to March, if the appropriations process is not figured out at that time, we will be halfway through the fiscal year that this budget is supposed to be addressing. And it'll be right around the time that this funding expires that President Biden is set to deliver to Congress his budget proposal for the next fiscal year. That is just how broken this appropriations process has become. And we'll see if this is enough time for them to actually sort out the 12 bills needed to pass both the House and the Senate to fund the government, Romaine.
All right. Well, having worked in Washington for years, I know nothing motivates Congress more than getting away for a 3-day weekend. Kayleigh, great to talk to you. We'll check up with you again soon, I'm sure. Co-host of Balance of Power there. Kayleigh Lyons, a closer look at that stopgap funding measure passing the Senate and now scheduled to be voted on at some point, potentially today, in the House of Representatives. As we count you down to the close with just 50 minutes to go, let's get right to Jason Trenner. He's chairman and chief investment strategist over at Strategas. Strategas, of course, is a Baird company. And Jason, I do want to start off not so much with the markets, but with what's going on in Washington and how it feeds into the markets. We already knew coming into this year with the election and some of the other geopolitical issues, this was going to have to be front and center for investors. But if we do sort of at least deal with the budget in some sort of, I guess, meaningful way, does that at least remove one of the overhangs, one of the risks coming out of Washington for investors?
If anything, I think it strengthens people's bullishness because, in my own opinion, I think we were close to a recession last year before Silicon Valley Bank failed, and we certainly had a backup in long-term interest rates before the Treasury Department interfered or intervened. And it seems like both the Fed and the administration are trying to pull out every stop to avoid a recession. Which is understandable. It seems inconsistent with fighting inflation over the longer term. So I have every confidence that they're going to pass something. I don't see a lot of profiles encouraged down there as far as spending is concerned. And I have a feeling ahead of election there's going to be a lot of pressure to pass more fiscal stimulus.
Well, let's talk about, I guess, what is, at least on a relative basis, the more sensible people in Washington. Those are the folks over at the Eccles building here, the monetary policy makers who have made it clear that they plan to keep rates elevated for quite some time. But they have made it clear they are open to the potential for rate cuts this year, not necessarily as many rate cuts as the market has priced in, though.
Yeah, listen, I think it makes sense for them to think about it because real rates have risen as inflation has come down. Of course, we don't know what their plans are. The dot plots tell you they're thinking about three rate cuts. That seems, I think, pretty reasonable given where inflation is today. I think 6 cuts, which the market is anticipating, would be difficult to see without some sort of economic conflagration or some sort of problem. So it's just hard to kind of get that kind of easing when I think there are still structural issues as far as inflation is concerned, particularly tight labor markets. So we saw the claims numbers this morning. It's just very hard in a service-oriented economy to get inflation down where you might like it to quickly, despite some of the increases in interest rates that you've seen.
You know, just marrying what you guys were talking about earlier with the political pressures in Washington, do you believe or do you subscribe to this idea that the Federal Reserve will need to cut in the first half or will move to cut in the first half to avoid any kind of big policy shift that right around the election or in a way that might benefit the Democrats during the election?
Well, I think certainly, I think the Fed does as good a job as any institution in Washington or any agency in Washington of trying to stay out of the fray politically. It doesn't mean that they're not political, but they're only political to the extent to which they want to stay non-political. If that makes sense. They can't be completely unaware of what's happening. And in that regard, it probably makes a lot of sense for them if they're going to do anything to do it as far away from the election as they can, lest they be seen as favoring one side or another. And my own opinion is that the Fed has time. I don't know if there's a big rush for them to either cut rates. Certainly, they don't need to tighten rates at this level, but I don't think they should be in a big rush, in my own opinion, just given the experience that we've had with inflation of this magnitude in the past. I don't know if they need to be in a real rush to cut rates a lot. And if they're going to do it, they should do it in the first half of the year, it seems to me.
Whenever the Fed tightens policy, everyone talks about the long and variable lags where you see the actual effects on the economy. When it cuts rates, what kind of variable or long lags are there, or do those not exist?
Well, it has. I think it has. In some ways, it has a more immediate impact on confidence and perhaps asset prices. It depends on. Generally speaking, for stocks, when you're getting into the first cut in a series of cuts, most of the time that's because the Fed is over tightened, and you don't get the vaunted soft landing that people are looking for. That it's very rare to find that. So, but generally speaking, a cut is met with some sort of confidence as far as the markets are concerned. It depends on why they're cutting, too. So it strikes me that at this level, the Fed will probably seek to stick the landing as far as the economy is concerned, and that should benefit investors this year. Hopefully, they haven't gone too far, and you'll find that out over time. I still don't think all of the tightenings have been fully priced into the economy, and that remains to be seen. It'll take some time for the cuts certainly to get in place.
Well, it creates an interesting stew, to be sure, for 2024. Jason, really appreciate your time joining us today. Jason Trenner is Chairman and Chief Investment Strategist over at Strategas, which is a Baird company. Coming up, we're going to count you down to the closing bell with Joyce Chang, Chair of Global Research over at JP Morgan. Will we get another year of U.S. exceptionalism in 2024?
And Sheryl Sandberg said goodbye as COO at Meta just a couple of years ago. And now later this year, she will say goodbye completely, stepping down from the board. We'll talk about her legacy at the social media startup that she helped to grow.
Adult in the room, anyone? Drug makers reportedly kicking off the new year with higher prices. More on the moves from Novo Nordisk and Eli Lilly. That's coming up. This is The Close on Bloomberg.
Pretty decent relief rally coming off a couple of days of sour sentiment in financial markets, and S&P 500 up about 0.8%. But the real action right now is in the tech space and specifically semiconductors. The Philadelphia Semiconductor Index up more than 3% here on the day. That's providing a nice lift as well to the NASDAQ 100, which includes a lot of those names. That was on the back of the commentary that we got out of Taiwan Semi. Commentary that seemed to suggest that we have finally reached a trough in the weakness in demand for a lot of those tech hardware projects. All right, let's get right to Abigail Doolittle, who's standing by right now with our Options Insights segment. And Abigail, you're taking a look at the market's very strange start to the new year.
Indeed, that is exactly what we're doing, although those are not my words. Those are the words of Mark Newton, head of technical strategy at Fundstrat. Thanks for joining us today, Mark. And I think that what you mean by that is, we have the S&P 500 earlier today. It was down on the year. Right now, it's up slightly on the year. Lots of choppy action in between. Most sectors are down. What's going on?
It has been a very choppy market, and this directly aligns with a lot of the election year seasonality that we see for the month of January. And honestly, it says the first quarter could end up being very choppy before we start to turn back to new highs. I would mention that the majority of sectors thus far are down over the last 3 weeks. Technology, the trickster, so to speak, has actually helped to buoy the market So the market's largely right around flat, but it's been a far different experience, I think, for many investors that are involved in financials or healthcare.
So we have volatility, and you're just mentioning tech. Of course, those earnings are coming up in a couple of weeks. And earlier today, I was putting together a chart, and I couldn't help but notice that we're in an earnings recession. Earnings are going down. They're being revised down, but stocks are going higher. At some point, that relationship is going to change. Do you think that that's going to happen at some point this year?
I do expect to see a drawdown in the first quarter. My thinking is that probably materializes in February, March. We would need to see some evidence of technology starting to wane. Breadth in general has been subpar over the last few weeks, which is following a 700-point rally in the S&P from October through end of year. So we've had this big move up, and now we're starting to stall. Certain sectors are pulling back. A lot of that is due to rates and the dollar having started to rally in the last couple of weeks, and that's important for investors to.
You like that rally, though. You think it will continue amid the volatility?
I think we do see a further rally in yields and the dollar over the next couple of months before both of them go to new lows. So temporarily, yes. I think that's what brings about our, eventual, consolidation. S&P needs to get under 4682, 4700 area. Until that happens, it's going to be choppy.
It's funny how charts can be so objective, because the last time I looked at both dollar and yields, same message, higher and then much lower, at least dollar. I don't know about yields as much. How would you suggest playing this kind of a scenario over the next couple of months using options?
So I do like implied volatility on an intermediate term basis based on where we are, but I'm worried about buying knowing that the near term is very choppy. So I like doing calendar spreads, time spreads, where we actually buy, February end of month puts on the S&P, say, for example, 465 puts, but we offset that by selling the, the end of January, which we have 13 days to expiration, puts for about $1.25. So you end up, it costs you a net debit of about $2.25, but you substantially save, on the total outlay for those that care. And that really protects you in the event that markets don't do anything, and that higher theta option will sort of grind up over the next couple of weeks before we turn down. So it's just a way of offsetting the cost potentially.
Yeah, and you brought a great point to mind with your notes that the commodity space and EM, emerging markets, are actually down relative to the S&P 500. Another reason to think that we could have volatility this year. Mark Newton, Head of Technical Strategy over at Fundstrat, thanks so much for joining us for Options Insight today. And from New York, this is Bloomberg.
Drug makers kick off 2024 by raising the list prices for Ozempic, Mounjaro, and dozens of other widely used medicines. Companies from Novo Nordisk to Eli Lilly increased list prices on 775 brand-name drugs in the first half of January, according to the Wall Street Journal, which cites data from a nonprofit drug pricing analytics group. So much for disinflation, at least if you're looking within this pharmaceutical space.
Yeah, when I saw this story, my first reaction was, I'm not surprised at all. I mean, we know that demand for this is through the roof right now. But primarily among a lot of people that probably shouldn't be taking it.
Me, not for
that's
diabetes.
That's a whole other question, right? But it gets to the question of why not do it? I mean, at some point, this isn't going to last, right? We know that demand is probably going to wane. And more importantly, at some point, there'll be more price competition. So you take advantage of this. And we've seen this with other new blockbuster drugs when they come into the market. You basically have all that pricing power in that sort of small window of maybe 1 or 2 years. So you take advantage of it.
You take advantage of it. Ozempic's price rose 3.5% to about $970 for a month's supply. Mounjaro, which is also a diabetes drug in the same class, climbed about 4.5% to almost $1,070 a month. But the thing is, in terms of risks, this is the one topic, high drug prices, that Democrats and Republicans can somehow find common ground on.
Yeah, well, you hope so. But yeah, I don't know. I mean, this is one that's going to be a little bit harder to touch, obviously, because there's still a lot of debate as to the necessity to use this drug for weight loss. And of course, we haven't really talked a lot about the idea that a lot of people are using this for not just cosmetic reasons, that there are legitimate health issues that they're trying to address. So anyway, it'll be interesting to see. Stick with us. A lot more coming up here. We're going to break down everything happening in the markets when we come back after the break. This is Bloomberg. This is the countdown to the close. Just about 30 minutes left to go here in the trading day, a day shaping up to be a lot different than what we saw the previous two sessions.
Yeah, we had 2 straight days of losses for the S&P 500, but today we've got green across the screen, at least when it comes to the main index, and for most of the pie as well. And that's because information technology, the heaviest weighted sector in the benchmark index, is up by almost 2%, thanks to semiconductor stocks, particularly TSMC, giving a lift to that whole sector. Communication services, and here we're really talking about Meta and Disney, doing quite well as well, gaining 1.4%. On the flip side, utilities and REITs extending their recent losses, both groups now down for a third straight day. Of course, these are very interest rate sensitive sectors. Romain?
Yeah, the technology is doing well today, particularly when it comes to the chip space here. Not so much in the healthcare space. One of the biggest decliners in the S&P 500, Humana, down about 8% here on the day. Now, remember, they're scheduled to report earnings next week, but they came out, gave a preview of what 2023 did, and well, did not do as well as investors had expected. KeyCorp did actually report their earnings, and they also disappointed here investors. Those shares down for yet another day, down about 4%, down a 7th straight day. And Bank of America continues its slide, down now for 8 straight days here. A lot of questions here right now about whether the bloom has really come off the rose, and more importantly, really pushing the ball back into the court of Brian Moynihan to really explain to investors here, articulate to investors that longer-term strategy. One of the few bright spots out there you're actually going to find in the trucking space, believe it or not. Some of this is because of the big rebound that we're starting to see after the big sell-off from last year. J.B. Hunt up about 3%. Those earnings, Scarlett, coming after the bell tonight.
And of course, we will break those for you when they do cross. Let's go big picture once again, because we want to lay out some of the best strategic and long-term investment themes out there. I'm pleased to say here with us in studio now is Joyce Chang. Joyce is JP Morgan Chair of Global Research. Joyce, so good to speak with you.
Great to be here.
So you noted that 2023 was really a year of U.S. exceptionalism. A lot of things were playing out, Fed rate hikes, of course, then a pause and a pivot all within this single year. How does that set us up for 2024? And I know we're already 2 weeks in, but what does that leave for us this year?
Well, I think everybody's asking, are we going to see a repeat of 2023 in 2024? That we had this easier financial conditions, that's leading to more upside risk to growth. And we saw that in some of the retail numbers that came out. But I think the difference is that disinflation trend that we saw throughout last year, it continues into this year, but I still am of the view that you're going to have global core inflation around 3%. So I don't think we have the space for the Fed to begin easing as early as March. I think that will only come later in the year. But we're seeing some things that are really repetitions of some of the trends that we saw in 2023. And I think it's still very hard to bet against U.S. exceptionalism.
Very hard to bet against U.S. exceptionalism, but markets are pricing in faster rate cuts than we might get at this point. What do you think is appropriate?
So, I mean, we are still looking at June for the first rate cuts, and our key concern is inflation. Mm-hmm. And if you look at the services component of inflation, I mean, that's still 2 percentage points above where it was before the pandemic. And we are seeing some of these geopolitical shocks also coming back in the horizon with the Red Sea. So this whole goods disinflation that we saw last year, I think that could be coming to more of a pause, and the services side is still very high. So I think it's the middle of the year, and you can see that the Fed has been dialing back in their latest rhetoric.
How do you chip away on that services side if you don't also see a significant chip away in the labor market and wages for that matter?
Well, I think that this is why I would really say that, and particularly if you look outside of the U.S. too, that we're looking at global core CPI much more staying at around 3%. And I think this, along with some of the hot retail numbers, is going to give the Fed pause on acting too quickly. Mm-hmm. So I think the market has to be patient, and it ran pretty far ahead in November and December right now. And so I don't think it's a point where you're necessarily going to see the end of some of this volatility that we've seen in the marketplace.
You talk about where we stand when it comes to global core inflation here. How linked and what are the correlations right now, globally speaking? It used to be that, if something happened in the U.S. or something happened in China, another large economy, you could kind of extrapolate pretty clearly what was going to happen to the rest of the economies out there. Is that correlation still as strong?
I think that it's much more divergent this year. So China was in deflation last year. We think it comes out of deflation, but with very low inflation. And you can see in Europe that they are having more of an issue with inflation. So we do have that basically their rate cuts are going to have to start later, in the cycle. So I don't think we're seeing as much convergence. I mean, the last year the themes were divergence, with the U.S. really sort of outperforming, and I think you continue to see that divergence. I mean, growth globally last year in the developed markets outside of the U.S. was only 1%, and if you take China out in emerging markets, it was 3 to 3.5%. So I think there will be more focus, on the growth dynamics as we do see U.S. growth eventually start to slow down more in the second half of the year.
One thing that people are noticing for 2024 is this pickup in animal spirits. There's definitely a lot more deal making, or at least talk of deal making. That we had an announcement of a Japanese home builder, for instance, buying MDC today. These cross border transactions picking up as well. You write that not much has changed on antitrust regulation over the past 3 years. What do you mean by that? Because we've seen a lot of interference from regulators.
No, we have seen a lot of noise, but if you look at the actual regulation, it actually hasn't changed that much. And in the Congress this year, particularly with all of the challenges they're having to avoid a shutdown, I don't see much going through on the legislative side. So you take a look at the regulators, there are a couple of big cases that we're watching very carefully, but for the last 3 years, we've seen sort of a lot of expectations and noise about what could happen, but the reality of what sort of has come through hasn't done that much of a material change. I mean, it's something we're watching very closely, but right now, it's not something where it would change the overall scope of the recommendations that we have in place.
I see. So things like JetBlue and Spirit not being able to go forward is more an exception than the norm, you're saying?
Yeah, I'm saying that most transactions, we have seen them, even if it has taken them a bit longer, able to proceed forward. And if you look at the whole calendar for the month of January, I mean, you sort of had record issuance that was, in capital markets transactions taking place across developed markets and emerging markets even.
There's still been a lot of optimism about emerging markets, and I know some of that is just kind of the effect of how low they had gotten here. But even some of the commentary we've heard coming out of Davos, particularly on the back of the speech that the new Argentinian president gave here, at least from an investor perspective, there seemed to be much more optimism that you could see some momentum in those types of economies in a way that we haven't seen in pretty much since prior to the pandemic.
Yeah, I mean, you bring up Argentina, but that's one where everybody really looks at the steps that the new government put into place, some very aggressive structural reforms that were very rapid and unexpected. So I think you are seeing a lot more investor interest in Argentina, but even in Turkey, where there are hopes that they can create some type of virtuous cycle. Emerging markets have actually managed this relatively well. The problem is the valuations haven't necessarily been more attractive compared to some of the other developed markets.
But you've heard from investors who've raised some concerns about the growth here in the U.S., whether you're talking about economic growth or even just price growth in markets, and the idea that they don't expect to see those outsized gains that we had in 2023. So go somewhere else to try to find those gains.
Yeah, but I think even in the emerging markets, we're looking at returns that are still sort of high single digits, and in the U.S. the same. So
with less risk, presumably.
So you look at something like the emerging markets local currency index, you have about a 6.5% yield, but you're getting 6% or so for U.S. high grade bonds. You're not taking on EM currency risk. So that's why some of the interest in the high yielders, looking at the Argentinas and the Turkeys, even though the middle income emerging markets countries like Brazil and others have managed themselves well, there's still a lot of interest in the Mexico and Brazil stories too, though.
Okay.
Joyce, really appreciate your joining us. Joyce Chang, Global Research Chair at JP Morgan, taking us on a trip around the world. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg.
Bloomberg has learned that the U.S. plans to push more banks to use the Federal Reserve's discount window. This story crossing the wire right now. U.S. regulators are basically preparing to introduce a plan. Now, this is going to come from the FDIC as well as the OCC, the Office of the Comptroller of the Currency, that would basically require banks under the purview of the Federal Reserve to tap the discount window at least once a year. And this is largely, I guess, Scarlett, to sort of reduce the stigma associated with that discount window. We saw this, of course, during the global financial crisis, where there were a lot of banks who were clearly in trouble, but they didn't want to go to the discount window because at some point that becomes public and then everybody knows you're in trouble. This also came up again during the SVB crisis. And apparently Michael Hsu, the acting comptroller of the currency, thinks that a better way to address that is to at least require everyone to come at least once a year to that window and borrow something.
At different times so that it becomes a normal thing and it's not something that you get punished for by investors when they see that a headline crosses. Let's bring in Katanga Johnson, who actually broke the news on this story. Katanga, you spoke with Michael Hsu, the acting comptroller of the currency. Give us a sense of what kind of timeline he has in mind for having banks tap this discount window.
Yeah, it's very clear that regulators, including the OCC, the Fed, and the FDIC, really want to make the discount window more attractive by requiring them not just to tap the window once a year to make it easier, somewhat of a fire drill, Sue told me, but also to focus on what plans or preparation for accessing it could be or could mean. Regulators are not specific on exactly when the plans will come across the finish line, but the hope is to have it done so in the coming months, so perhaps in the first quarter.
The other issue, Katanga, that we know, in addition to, I guess, the so-called stigma associated with this, there was also a cost factor. And I know in years past that wasn't much of an issue. But now in an age where you have a lot of private capital sloshing around that banks can turn to here, is the cost to go to the discount window going to be competitive to maybe what some of the banks could get in the private market?
This is an open question. Regulators are considering attractiveness in a number of ways. It could include as well the cost of accessing the discount window. But it's yet to be seen exactly in the plan how they would reduce the cost, if so at all. I understand that from our reporting that it is statutorily required for regulators to hold that cost at a particular rate. And so it's yet to be seen if they're able to tinker with it within the confines of the regulations as it stands.
Can you give us a sense of what else Michael Hsu and the other regulators have in mind to make sure that something like what we saw in March 2023 doesn't happen again?
Regulators really want to, in addition to robust plans from a larger swath of banks, including mid-sized lenders, really want to see a number of changes to how banks think about the discount window, but liquidity in general. The assets that are sort of held to maturity in their balance sheets is a consideration, maybe counting those in a different way, as well as a number of other reforms. There's also, of course, other reforms to capital, to long-term debt, that'll probably work in tandem with a bank's consideration around their balance sheets. And regulators hope that together these reforms will play a role in mitigating the risks that banks might face if there were such a rapid bank run again.
Katanga Johnson, thank you so much. Bloomberg Katanga Johnson on how the U.S. is prepping rules to push more banks to use the Fed's discount window. This is The Close on Bloomberg.
This is the countdown to The Close. Romaine Bostick alongside Scarlett Fu. We only have about 10 minutes to go, Scarlett, until we get to the closing bells. But the narrative this afternoon, a lot different than what we saw the past couple of days.
Yeah, although this week has been a reality check for those who are expecting 6 rate cuts by the Fed this year.
Yeah.
You're seeing it calm down a little bit today with the S&P 500 being powered higher by semiconductor stocks. The NASDAQ 100 is the big winner of the day, up by 1.5%. You're looking at a 2-year yield that's little changed right now after yesterday spiking 14 basis points on hotter retail sales. The jobless claims numbers that we got today also really signal that there's plenty of U.S. labor market strength. And there's a little bit of concern about inflation maybe picking up again later on. Oil prices are moving higher with WTI up by better than 2%.
Those oil prices moving higher, a stronger labor market. And we were talking a little bit earlier about Walmart and the pay and bonuses that it's giving some of its retail managers here. Just one company, but still indicative of the fight that the Fed is up against. Amy Kong joining us right now, partner and wealth advisor over at Corient, as we count you down to the closing closing bells. And Amy, I do want to start off here with the inflation picture overall. And we know it's complicated. And I don't want to get too much into the ins and outs of whether the Fed will cut or whether it won't cut. But more importantly, whether investors can be comfortable enough, I should say, with where inflation is right about now, given that it does appear that we're not probably going to hit 2%, that 2% target anytime soon.
Hi, Romaine, Scarlett, good to see you. Great question. And I think for the moment, considering that wage inflation is still at the 4% level, I believe that consumers are comfortable, and obviously investors as well, are comfortable with the fact that CPI has not reached back to the 2% level. And I mention that because at the very moment, we see wage inflation is covering inflation. But of course, if that starts to reverse course, I would imagine that the scenario would be a little bit more negative.
It seemed like, particularly towards the end of last year when we had that big rally and now November and at least in the start of December, there was a lot of correlation between that drop in yields and the expectation that those yields would continue to fall. We're now kind of seeing the reverse of that with yields ticking back up again. Is that going to materially change the models and change the valuations and, more importantly, change the risk appetite for growth stocks?
Yeah, I think if the yield starts to bounce around, which we've seen over the past week, I don't necessarily see that changing the models too much. But I think where you might start to see investment sentiment start to shift more rapidly and more meaningfully is, for example, yields were at 5% back in the summer, dropping to as low as 3.8 and change by the end of the year. And now bouncing above that 4% level. If it shoots higher to the 4.5–5% range, that's where I think the sentiment may shift a little bit. But a little bit of bouncing back and forth is really a reflection of markets and investors trying to grapple with the valuation of the stock market and little tidbits of news suggesting Fed may cut, Fed may not cut. And I think that kind of bouncing around is likely to be the story over the next coming weeks.
Yeah, as long as it's not like super volatile like we saw at different points of last year. I want to get your take, Amy, on the earnings that we have seen roll in. The healthcare sector, for instance, health insurers under a lot of pressure after Humana warned that higher medical costs could dent even this year's annual results. Give us a sense of what you're learning from these companies that kind of ratify some of your positioning.
Yeah, so far the earnings that we have seen, and it's only been about 10% of the S&P 500 that have reported, the fourth quarter has been okay and has more or less been meeting consensus expectations. I think to your point, the market is more focused on what's going to happen in 24, and we're starting to see different pockets of the market. Again, whether it's guidance leaning towards conservatism, in the case of Humana, suggesting that medical loss ratios will be much higher than expected. I think that is likely to be the focal point going into the next several weeks. With regards to Humana specifically, I think there could be more political rhetoric that might rock the healthcare managed care sector, and that's probably likely to happen. But I think for the most part, from what we've seen in terms of earnings, it's been okay. And positioning for us has been, obviously the tech sector has done very well last year. For us going into this year, it's probably looking at what's outside of the Magnificent Seven group to make sure that there's a good balance between, again, tech growth versus other sectors.
Yeah, well, for so many investors, healthcare proved to be that other sector outside of technology because of its safe haven quality and also its growth prospects. I do want to touch on the big tech names very quickly here because as they get ready to report, are we going to see efficiency and cost cutting as the big theme once again for these names?
Yeah. Considering that the valuation levels for many of these tech companies, especially those in the Mag 7, have really rocketed through the fourth quarter, I think the expectations could be on the higher end, and that could be a risk going into the fourth quarter earnings season. From my perspective, I think these companies likely will continue to demonstrate good pricing power. In the case of the NVIDIAs of the world, again, just strong growth in general, just being able to sell chips to China, et cetera. And for us, it's really making sure that the cash flow remains resilient and that, again, from the standpoint of cost cutting, that has been part of the story. But for us, the focal point is thinking about how are they staying innovative, how are they creating cash flow, and hopefully keeping that pricing power throughout, again, a more volatile couple of quarters from our perspective.
But are you seeing those signs of that right now? Because when we do talk about the health of some of the balance sheets for that company as well as others, it still has been about cost cutting, meaning what they're taking out rather than maybe what they're growing and putting in.
It's a function of both, Romaine, and I think, again, it's more case by case, quite frankly. So looking at the specific companies, we have seen a good balance between being able to price, whether it's in the case of Microsoft and their ability to launch a couple of AI-related features, both on the user end as well as the app development end. Again, it's a function of both the top line as well as being able to keep expenses on check. And I think that should continue going into this quarter and next. But at the end of the day, that starts to fade out a little bit because how much cost cutting can you do? I think a lot of the low-hanging fruit, if you would, has already been realized.
Yeah. All right, Amy, always great to talk to you. Amy Kong over at Corient, helping us count down to the closing bells. We just got about 3 minutes to go, Scarlett, and I thought her last comment was important because we've talked so much about the cost-cutting efforts that these companies have made, the year of efficiency.
Yeah.
But that only gets you so far, right? I mean, if you've got a lot of fat to cut, maybe that gets you further, but there are a lot of companies out there that were already relatively lean, so there's only so much they can do without hurting the business.
Although, as we've seen from companies like Salesforce, for instance, there was plenty of fat to be cut, and there could be a lot more to come, especially if you've got an activist investor kind of staring you down from the sidelines.
Yeah, these activist investors. I mean, do they ever just articulate what they want? I mean, some do, but a lot of them are just.
You're saying they're passive aggressive?
I mean, I'm not saying they're passive aggressive. I'm just saying just say what you want. And sometimes,
put me on the board.
And we talk about Disney and the whole fight with Nelson Peltz, and that was Iger's comment. That basically, I don't even know what Peltz wants. Now, I don't know if that's true or not, but it gets to the general idea.
They apparently did have a one-on-one conversation, so presumably they talked about what he wants.
Did they, or did they just talk about like gummy bears and something else? All right, we're moving closer to the closing bell. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Pineapple Gummy Bear Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, Tim, radio, Tim, as well as Bloomberg Originals. And yes, Tim, those folks still streaming us on YouTube. And yes, you told us the last time we checked in here on this program about the pineapple flavor. That's how I learned it, unless you lied to me.
It's the white-colored gummy bear, by the way.
Okay, just making sure. So even the different colors are different flavors. Yes. I need to know that. Okay, we're talking about this because there's a great Business Week story. I just confirmed.
I have not confirmed that.
I don't know.
I'm going to do on-the-ground research tonight.
Do you guys know
for the team? With this story.
Do you guys know Stuart Paul at Bloomberg Economics?
Yes.
He's obsessed with gummy.
He works here.
He loves Haribo. He says he brings in. He says he brings.
He loves Haribo. Is there somebody who hates Haribo?
But he says he brings in on Mondays enough for the entire week into his filing cabinet.
For all of us?
Just for him.
Oh, just for him.
It's enough for the whole week, but then it's gone by Wednesday.
Snakes, sour gold bears.
Well, the great thing about the Bloomberg terminal, I can look up where he sits, and let's just say, lock your desk, my friend.
His filing cabinet is not safe.
Hey, having said that, I don't know if there's a semiconductor gummy bear, but you're definitely seeing semis. I had no good translation.
That was good, Carol.
Yeah, I tried.
That's gold.
Look at the stocks. It's up 3.4% today, thanks to TSMC. I'm going to talk about it more in my gainer, so I'm just going to go ahead. Gummy bears. It's all gummy bears today.
All gummy bears. Well, I mean, actually, it is all tech. In fact,
gummy bulls.
All chip
gummy
stocks.
Bulls?
Yes, you missed your chance there, Carol. Come on, just walk away, reset for next time. Let's walk through the closing bells here as we get to some of the big movers, because this was a tech-driven rally here on this Thursday afternoon. The Dow Jones Industrial Average, believe it or not, that was your relative laggard. It's in the green, though, on the day, up by about 200 points or about 0.5%. The S&P 500 is going to close out the day higher by about 0.9%, but it was really the NASDAQ and the Philadelphia Semiconductor Index that really shone today. The NASDAQ Composite up 200 points or about 1.4%. And the Russell 2000 also higher here on the day. In fact, we had green across the screen for all the major indices. The Russell up 0.5% as well.
Yeah, exactly. And you take a look at the S&P 500, guys. Most names in the index higher today, 331 to be exact, 169 to the downside. So there were some names that lost ground. That was a gift to Tim because he's got to do decliners. And then Scarlett, you had about 3 unchanged today.
Let me just jump in here with
Sure.
sector performances. A sea of red and green. Red, by the way, raspberry red if you're into Haribo gummy bears, and green is strawberry green. Just in case anyone was following up
green
from our
is
previous
strawberry?
conversation. Yes,
Yeah.
yes. They're really yummy too. Okay, tech, hardware, and
don't
semiconductor
get
stocks
distracted,
leading the
Scarlett.
way. I'm trying not to be distracted. Carol mentioned the chip stocks. That's the second best performer group, up 2.5%. Transportation also doing well thanks to airlines recovering, up by 1.9%. On the downside, you have autos off by 1.7%, utilities, and household and personal products. So some more defensive sectors in the red.
Sorry, I just want to break in here. Macy's right now moving here in after hours trading here. A report by the Wall Street Journal that the company plans to lay off 13% of its corporate staff. Again, this is according to reporting by the Wall Street Journal. The company also says, the journal, I should say, says that Macy's also plans to add more automation to its supply chain. Overall, it's saying that Macy's will cut about 2,350 jobs. It will also close 5 stores, and that includes, those job cuts includes about a 13% reduction in its corporate staff. Now, overall, that 23,550 job cuts amounts to about 3.5% of its total workforce.
All right, stock was down about 2.5% last year. This year, it's down about 11% here. So it's kind of that sad news means maybe they cut some costs, and maybe that's why we're seeing perhaps the stock a little bit higher in the aftermarket. All right, guys, let's get to some of the individual gainers. You talked about it. We talked about it. The semiconductor sector really outperforming. The stocks rallying, and really it's all about TSMC. You saw Taiwan Semi up almost 10% in today's session, bringing some optimism. They're a bellwether. They came out, the company's CEO, saying they're upbeat about the year, talking about a recovery that we could see, that maybe then that will play into kind of a recovery for the overall tech sector. They talked about it being led by AI in particular. And then so we definitely saw just really some outperformance there within the whole group here. And if you look at some of the biggest gainers, whether it's the S&P or the NASDAQ, it was those chip names. So again, giving up their outlook, talk about really some recovery here in 2024. We talked with Ian King, who follows semis for us here at Bloomberg, and he's like, this is a big deal. They're a bellwether. If they're being optimistic, that's really a positive sign. Do you want to mention Apple also providing momentum to the trade today, finishing with a gain of about 3.25% here. What a week. They've had a weak start to 2024, three downgrades at least, but they definitely got an upgrade today. B of A upgrading the company to buy from neutral. They say AI will be a driver for the company's hardware and services business, according to the analyst, who wrote that he sees a stronger multi-year iPhone upgrade cycle driven by the need for the latest hardware to enable generative AI features to be introduced this year, next year. I know, AI once again, right?
Are you going to buy one of these Vision Pro headsets?
They're only they're what, $3,800?
What?
Is that right? 3,800.
I mean,
that's a lot.
What would you use it for?
When would you use it?
When would I use it?
Well, I mean, that's the question. Everybody's saying, what's the use case for this? Obviously, we know you can play games and, in theory, watch movies and stuff.
No,
but,
Netflix won't be on it, apparently,
well,
right?
other movies. There's other places other than Netflix.
Wait, what,
Scarlett,
really?
Foo.
Scarlett makes a really
Scarlett,
important point.
riding hard for Netflix. But
I pay for it, so that's the one I'm
Wait. Can I just say this analyst says he thinks the upcoming launch of Apple's virtual reality headset has potential, writing that revenue for the product could surpass iPad revenues over time as spatial computing takes hold, offering differentiated use cases, driving services upside. I know it's a lot of analyst talk, but nonetheless, he sees it as maybe a push to the upside.
And how many people, though, have you spoken to? They've talked about this idea that you need to also find a use case for it that goes beyond just entertainment, right? That if you can create productivity tools and work tools, then maybe there'll be better adoption.
I guess TBD, huh?
What else you got?
One. I got Boeing rallying. Can we bring it up for everybody? We saw this stock move to the upside, up about 4.2%. You know it's had a tough year. They won an order for 150 MAX jets from India's newest airline, a rare spot of good news for this company. We know the news, the fuselage, piece of the fuselage blowing off Alaska Airplanes. What was that, 2 weeks ago now? So Alaska, this airline, Akasa Air, ordering MAX 10s, MAX 8200s for delivery through 2013. Some quick math. Based on Bloomberg, we did some quick math. Maybe, Scarlett, it's about $17.5 billion this order could be worth. It does not include, though, the MAX 9 variant. So let's get to some breaking news. I know you're on that, Scarlett.
Yeah, let's take a look at J.B. Hunt. Operating revenue for the fourth quarter, $3.3 billion. That is higher than what analysts had anticipated. They were looking for $3.27 billion. When it comes to fourth quarter bottom line, EPS of $1.47, missing the average analyst estimate of $1. Hold on, I just had to pull it up again. Sorry, my
It was
screen is not
$1.74
working. There we
versus
go.
$1.47. So that was where the miss was there.
Yeah.
Dedicated revenue, fourth quarter dedicated revenue also missing the mark, $883 million. Analysts were looking for $903 million. To what extent do you think this is a bellwether for the transportation industry, for the not shipping, but the freight industry, given that there's been a lot of disruption, a lot of changes there?
I mean, well, they're pretty much the biggest last mile player, at least in terms of, standalone, shippers. Obviously, the real bellwether is what you hear out of UPS and FedEx. But, I think you can extrapolate here that if goods, and meaning the goods that we're buying, is down, particularly on some of those more high-priced goods here, that has a direct line through to J.B. Hunt. So maybe you can have the reverse line going back to extrapolate as to what we're doing.
They do talk about Final Mile and their services there. They said the decline primarily driven by general weakness in demand across many of the end markets served, in addition to efforts to improve the overall business portfolio.
But when you hear about companies getting their inventory in shape, and then we were just talking about Macy's cutting jobs and things like that here, that's the good sector, right? And if that is weak, at least we're getting anecdotal evidence that it's weak. You would think that that's going to show up in the earnings for these trucking companies.
You bring up a good point, and we did speak to Stuart Paul about things other than gummy bears a little earlier in the day, and he did say that they start with the anecdotal data. And we start to hear about things like job cuts, Scarlett. We start to hear about things like, freight coming down and volumes declining. And then you start to see those results in the actual data. And he and Bloomberg Economics still thinks there's actually going to be a Fed rate cut in March. They're sort of not in the minority at this point. Yeah, in March. And we were surprised to hear that. But he said there are a lot of signs that are pointing to weakness that are out there right now.
Well, some of the anecdotal might be there. Worth mentioning as well, J.B. Hunt raising its quarterly dividend, so maybe taking the sting out of that earnings miss and the revenue miss, at least when it comes to dedicated revenue, by raising it 2.4% to 43 cents a share.
Yeah, this gets to the idea, though, too. I mean, particularly as we get deeper into earnings season next week and the week after, where we get that bigger cross-section of companies and sectors, you'll get a better sense maybe of how things are. But at least right now, between what we heard from the banks and at least this one anecdotal thing out of J.B. Hunt, I don't know, not looking good.
What about TSMC, though? I mean,
that was good.
There's some real optimism there.
I'm all in on chips and gummy bears after today.
No, really?
Yeah.
Hey, we have Brad Jacobs of XPO coming on a little bit later on.
Does Carol not like gummy bears?
I actually don't. I don't. I like Swedish fish. Yeah.
And same family, gummy candy.
Oh my gosh. How dare you?
Same genetic kind of, or not?
You apologize to the gummy bear.
You couldn't hear that if you were on radio, but I did kind of a homage.
Bow down.
A bow down. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals.
Did we talk markets or no?
We did, yeah.
We mentioned it. We talked earnings.
We cover it all. All right, we will see you again tomorrow, everybody.
And we continue our coverage right here on Bloomberg Television, a deeper dive into those results that we got out of J.B. Hunt, the big trucking company, and what it means here for the state of the U.S. consumer and the economy. That's coming up next on The Close. This is Bloomberg. All right, today was a good day in U.S. equity markets, about 0.8% gain on the S&P 500, but it was really about the moves that we saw in tech stocks, specifically the Philadelphia Semiconductor Index, a 3% gain here on the day on the back of those comments by Taiwan Cindy. And you look at the ratio of the Philadelphia Semiconductor Index versus the S&P 500, we're actually back to some of the highest levels in favor of the Philadelphia Semiconductor Index, going all the way back to 2001 and 2000. A lot of people think that will persist because most of the bright spots in the tech space right now, they're really not in software and services. They're much more in hardware and chips. That could be a big part of the story as we move into next week and we start to get some more tech names, and of course the week after that as well. Taiwan Semi had a great day. Its ADRs here in the U.S. up by about 10% here on the day. Not much action today on Bitcoin. In fact, Bitcoin now just deciding that it doesn't want to be the story anymore, dipping back down below the 41,000 mark. And rates, at least to a certain extent, were kind of kept in check here on to the day, despite that big increase that that we saw, or drop, I should say, that we had in those jobless claims numbers. I was also taking a look here at the Russell 2000, because remember, headed into this year, late last year, we started to see that outperformance of the Russell 2000 versus the broader market, the outperformance of the S&P mid-caps versus the broader market. But that is clearly waned right now. And for the Russell 2000, that resistance has been around that 2000 mark. The close today was right around 1900 here, and most of the technical levels seem to suggest that it could be in for, well, a little bit of an issue here. It's stuck in a tight trading range, and the only thing, Scarlett, that could really break it out of that range is some material change in the fundamental story. But at least based on the projections over at Bloomberg Intelligence, it doesn't seem like we're going to get that out of this particular earnings season.
Yeah, and of course, we'll continue to watch that. Maybe the small caps had their January effect rally back in December, given the performance there. All right, let's go from small caps to the mega caps and talk about Microsoft, because almost a year after Bing started incorporating ChatGPT into its search engine, and it turns out internet users have barely budged. What happened is that use of Bing has increased, but Microsoft's share, or Bing's share of the global market, is up less than 1% for all of that. For more now, let's bring in Rachel Metz from San Francisco. Rachel, it's so good to speak with you. Tell us a little bit more about what we've learned about Bing, the usage of Bing, because you would think that with all the bells and whistles Microsoft has attached to it with ChatGPT and all the other functionality, it would have seen more of a payoff.
Yeah, I think part of what we're seeing is that search is really hard to gain market share in, especially at this point in time when Google has been leading for so many years. And also Google is not sitting still, right? They're adding their own generative AI features. So it's quite competitive there. It is the fact that Microsoft added a little bit of share, right? Like people were really excited about Bing initially when they added ChatGPT to it last spring, and so they did gain a little bit of market share. But in a market share a market so heavily dominated by Google, a little bit is not that much overall, right?
Right, absolutely. And I guess consumer behavior is difficult to change when it comes down to it. People are used to seeing a Google search screen as opposed to a Bing search screen, even if it's by default built into certain hardware, like laptops, for instance. How is Microsoft responding to this?
I think what they're trying to do is just keep plugging away. I mean, they have a very deep partnership with OpenAI, which is the maker of ChatGPT. They've also made it so that users of Bing can use the latest version of DALL-E, which is OpenAI's latest image generation software. So it sounds like they're still trying a bunch of different AI-related innovations to see if that will make people interested.
It raises a lot of questions too, Rachel. When I saw those numbers and the fact that they didn't get a material boost, I guess it was sort of material. I guess if you want to do a percentage of a percentage, I mean, it was a pretty significant jump, just up to 3-something%. But it raises the question as to whether the consumer-facing chatbots that we've all been obsessed with are really not the thing we should be paying attention to when it comes to AI and generative to AI. Is the real story here, and more importantly, the real, moneymaker, potential moneymaker, going to be much more on the back end side of this and what corporations are doing with it internally?
I think it's important right now to keep in mind that a lot of the generative AI that we're using as consumers is still really experimental. People are still playing with it, learning about it. We also know that it's also not all that reliable at this point, right? So you might be using it for something search related, but then you're going to want to check the facts. If you have to check the facts with a search engine, like how useful is that really at this point? So I feel like it's going to take a while for people to really decide if they want to use this and how to use this. On a daily basis. Google search, we didn't just magically start using all the time overnight when it first came out, right? It takes some time for people to get used to these tools and figure out how to best use them.
Right, and Google also drove a hard bargain on some of those deals that sort of made it the default on a lot of our devices. I'm told there's been a few lawsuits over that. That's a whole nother topic of conversation. When it comes to the investment, though, that Nadella has made into OpenAI and just really in Microsoft's own AI dreams here, is there a sense here that it doesn't necessarily matter if the search engine market share, does that not really matter if they can sort of leverage the power of this in other products themselves, such as Microsoft Office and some of the other suites that we are more addicted to, maybe much more so than the Bing search engine?
Yeah, I think that's a really good point. I mean, they're incorporating OpenAI's technology into a lot of different parts of their business. Their business is hugely an enterprise business, right? Not this consumer-facing search business. I think consumer-facing search is great because it gets people to try things out. Maybe people will become users overall and use it over time. But really, I think there is value in getting into other parts of their business. I think they understand that really clearly.
All right, Rachel Metz, thank you so much for joining us. Rachel Metz covers AI for us from San Francisco. We do have some breaking news here. It is on JP Morgan's Jamie Dimon, the CEO, his total compensation for 2023. Turns out he earned $36 million in total pay, in total compensation for 2023. That compares with $34.5 million in 2022. So once again, JP Morgan raises its CEO's pay, Jamie Dimon's pay, by 4.3% to $36 million in 2023. Sonali Basak is here with us, and Sonali, of course, covers Wall Street for Bloomberg News. JP Morgan, Jamie Dimon had a pretty blockbuster year. Every guest that we talk to talks about how JP Morgan is kind of the benchmark when it comes to the big banks that they're looking at, that they're investing in.
Yeah, and remember, this is really the first set of large bank CEO pay packages coming out of the gate. And we know that JP Morgan, stock performance-wise, did a lot better than everybody else. The board, in its statement, in the filing that had come out, did cite the significant challenges of the regional bank turmoil and ongoing growing political tensions, and Jamie Dimon's ability to navigate those things around the world as part of the reason for this compensation increase at the end of the day.
They benefited from it. They bought First Republic.
Exactly. And they did indeed cite the record revenue for the 6th consecutive year at JP Morgan. Of course, that was also aided in part by that First Republic acquisition.
Give us a sense here. Are the other big bank CEOs going to see similar pay packages? Because I feel like at least in the more recent years, they've been relatively neck and neck. I mean, you know, $1 million here, $1 million there, difference here. But there doesn't seem to be a lot of variation these days. Why not?
A few reasons, and we did see in recent years either static or even lower pay because some of these banks have had some troubles that they've run into. I think, for example, if you look over at Goldman Sachs, how are they going to assess him this year in the middle of a very big set of strategic changes being made? Some things you've also seen in recent years is special bonuses in good years that shareholders actually have objected to. In the case of JP Morgan, for example, you did see some pushback. So, you know, you think about the rise, of course, 36 million is significant, but at the same time, it was a banner year for JP Morgan. It's not, you know, relatively a massive jump, right? But it is an increase.
That's still a lot of money, though.
It's still a lot of money.
It's not Tim Cook money, but
you
it's
want to
still
hear
a
a fun fact, though?
Sure. Give me a fun
It is a lot of money, but yeah, it's not Tim Cook money.
Yeah.
If you look at kind of the most highly paid executives, most of them do not come from the financial industry.
No.
And so you do have, for example, Jamie Dimon, 36 million, over at the private capital counterparts, they're shelling out hundreds of millions of dollars over a couple of year span. So that's the competition that they're facing.
They don't have the regulatory oversight that JP Morgan does. Just to note here that Dimon's total compensation includes an annual base salary of $1.5 million and performance-based variable incentive compensation, bonuses and the like, of $34.5 million. I know this question gets asked a lot, but what do we know about succession planning over at JP Morgan? Because for a long time, the running joke has been, ask me in 5 years, ask me in 5 years. Where are we in that cycle?
Ask me in another 5 years. No, one thing that's important to note is, and we see this normally in the proxy filings, what all of his deputies will be compensated in this era as well. We are watching a few women in particular. We're watching Marianne Lake. We are watching Jennifer Pipsack, for example. In recent years, they've been given new roles, expanded roles, and they have worked in many different parts of the business. And Jeremy Barnum, his own CFO, has been playing a very public role these days as well. So the future of JP Morgan, in addition to Daniel Pinto, those women are in particular who we're keeping our eye on.
All right, Sonali Basak, who covers Wall Street for us, the latest news here on the pay for Jamie Dimon, the CEO of JP Morgan, a 4.3% bump in total compensation to $36 million for 2023.
Topped inflation.
All right, we want to continue here in the finance space here and talk a little bit about the comment period for what is really a very divisive proposal. We're talking about the Basel III Endgame proposals, which ended earlier this week, that comment period, I should say. The Securities Industry and Financial Markets Association, better known as SIFMA, sent a letter to federal regulators saying, quote, "We continue to be very concerned that the proposed 129% increase in capital requirements isn't supported by any detailed analysis, and if the necessary changes aren't made, a reproposal may be necessary." Ken Benson joining us right now. He is the president and CEO of SIFMA. Joanna Benson served as a House representative several years past and now, of course, represents the meat and potatoes of our financial sector. Ken, let's get right to it here. I mean, you're not alone in that sentiment here. I mean, just a couple days ago, I think it was yesterday, actually, if I remember correctly, we heard from Fed Governor Michelle Bowman really talking about some of the proposals out there, at least coming from the U.S. side, and the idea that they really needed to be rethunk. And more importantly, it might be some time before we really get to a point where we can have something definitive on the table.
Well, Romaine, first of all, thank you for having me. And I want to go back to something you just said about the meat and potatoes of the financial system. We represent the capital markets area of the financial system. And in the U.S., that is the meat and potatoes of how non-financials are financed, whether it's large companies, small companies, consumers, investors, et cetera. And the problem with this proposal, well, multiple problems. One, it's highly complex. Two, it has a dramatic increase in capital, just not on large banks on their overall capital, but on their trading activity, which again is the meat and potatoes of our financial system. So it has will have serious knock-on effects into the price that firms have to pay, whether it's for financing equipment, financing mortgages, expansion, growth, and plant and equipment. And so that's number one. Number two, the process is not very good at all, because as you pointed out in our comment letter, it'll have a 129% increase in trading book capital to begin with. But the Fed and the other regulators did not do a quantitative impact study before they put this proposal out. They're doing one now, which is great, but they really should have done it beforehand. And they really need to reopen for comment once they release the quantitative impact study. We did our own quantitative impact study. That's where we came up with their numbers, and we're pretty confident that's what they're going to find as well.
But I am curious. I mean, some of the folks who are in support of these increased capital requirements really focus in on this idea of how do you identify, I guess, what's risky or what has systemic risk on the balance sheets of these companies, how big these speculative sides of these businesses are. The proposal, at least as we know it to be now, do you think that addresses it in a fair enough way?
Well, let's remember, over the last decade, we've seen capital increase threefold and liquidity increase ninefold for the large financial institutions that are impacted by this. And we've gotten through really quite well. Second, the proposal was put out as having only going to increase, capital by 2% or up to 20%, I should say, overall. And it was suggested that trading book capital increases really weren't important because they didn't affect Main Street economics. But in fact, in the U.S., they do. And Main Street finances itself through the capital markets in the U.S. And so this is going to have a really broad knock-on effect, and particularly when you consider the fact that the banks that are impacted by this have 50% of market share in traditional securities products, whether it's derivatives, securitization, corporates, munis, treasuries, and the like. And when you add in the foreign banks that are also impacted by this, you're talking about 90% market share. So then you have a question of where the capacity is to fund it, and the only result's going to be increased costs. So we think that you really have to go back and start over. And the first thing to do is to do a quantitative impact study like we did, which now they're doing. But I think they're going to have to repropose once they put that study out.
Well, it seems like you have a couple allies sort of on the inside who kind of agree with you. But my question is, how much have you spoken with them, particularly about the difference and the disparities in data? And how do you reconcile that? How do you go to them and say what you're looking at is wrong, what we're looking at is right, or at least gives a more accurate representation of what's going on?
Well, we certainly have been weighing in with the Fed, the Comptroller of the Currency, and the FDIC on this. And we did decide to do our own quantitative impact study because they had not done one. They're doing one now. And we look forward to going back in and showing them. We've now presented them our numbers when we filed our comment letters this week, and we're eager for them to go in and review our numbers with them. We feel quite confident that they're going to find the same thing we did, and it's a stark difference to what they thought that the proposal was going to be. So it really does underscore the need that some of the governors you mentioned have raised, that they need to start over.
We only have about a minute left, Ken. I am curious here, for the folks who are advocating for these higher capital requirements, they say that, look, you raise the capital requirements, the banks pull back, but there will be enough money and enough players out there in the private side of this who will sort of pick up the slack. Do you not buy that?
I don't buy that, because when you look at the market share that the U.S. G-SIBs have and the foreign G-SIBs have that are impacted by this proposal, you're talking about 90% market share in traditional securities financing. And yes, there are certainly we represent all of the players in the capital markets, all the major players in the capital markets area, but that's a lot of capacity to be impacted. It's really nonsensical not to think that it's going to have a knock-on effect into pricing, capital allocation that affects, mainstream financing.
All right, Ken, great to catch up with you. Ken Benson there, of course.
Thank you,
absolutely, he is the head of SIFMA. Coming up here on the program, we're going to take a closer look at the consumer and luxury retail, apparently bouncing back after some strong earnings. That's coming up after the break. This is Bloomberg. A solid day for U.S. equity markets here on this Thursday, though it was a bit lopsided when we talk about the gains. The S&P 500 did finish the day higher by about 0.9% here, but it was really big tech that led the charge here. You see that reflected in the NASDAQ that finished the day higher by 1.4%. But how about the Philadelphia Semiconductor Index, a more than 3% gain here on the day? Once you sort of strip out those big tech names and you strip out some of those semiconductor names here, it was a little bit less of a rally that we saw. You see that reflected in the Russell 2000, which only gained about a tenth of a percent here on the day. A lot of questions right now about not only the state of the U.S. economy, but the global economy as well, Scarlett, and whether consumer spending will continue to be resilient, and more importantly, resilient enough to justify some of the valuations in the market.
Yeah, that resilience is an open question, especially when you have Ken Mullis warning U.S. economic growth could slow as consumers grapple with dwindling savings and the impact of those Fed rate hikes in recent months. The Mullis & Co. CEO spoke with our very own Francine Lacqua at the World Economic Forum in Davos. Take a listen.
I think right now it's, going into, let's say, the November Fed meeting, I think people were still worried about how high is up. And now most of the conversation is how quick do we come down. And, I think people are different on that. Some people think June, March, but most people think it's a matter of when, not if, and that the direction on rates is going to come down. And really that's going to unlock a lot of deals.
So where are the opportunities?
I think there's going to be a lot of things coming out of private equity. The amount of capital that's been locked up. It's really been, it's been 2 years really that the market has been going through this weight on rates and this. So I just think you're going to have a bunch of portfolios that want to liquefy. And then also strategics have their plans. I mean, I think what's amazing, especially in the United States, is just how active and how aggressive strategics have and want to be on fulfilling their plans and their 5-10 year desires, and I think they're going to move on it.
But this is what, regionally opportunities, or is it sectors that you think will be unlocked?
I think you're seeing. I mean, the energy in the healthcare sector is stunning. The technology sector continues to create opportunities in a way. I mean, during the year, we took advantage of a situation and doubled the size of our technology team. When Silicon Valley Bank went down, we hired the whole team. But what was most startling to me is when we went through the coverage universe, there were literally hundreds of companies that I probably never heard of that have been created and are sizable and are addressing markets that are very interesting.
You've hired 27, right?
Managing directors this year,
in 2023. How many more this year?
Well, I think we're going to keep going. But look, last year was the year to do it. We are in a funny world. The best talent in the industry is not available when you want it. It's available when they're available. And that's usually, it's hard to remember, we started the company in the 08-09 crisis. And the reason we were able to grow so fast is because in that market, everybody was shrinking and scared. And we felt 2023 felt like a similar moment for us. Big banks were shrinking, pressure from their shareholders, capital needs. And we decided that we're in a good position. We're unlevered. We have a great culture. And we decided to grow. We expanded the firm by almost 20%.
But unexpectedly? So, do you basically swoop up, a good talent when they get laid off?
It's kind of unexpected because we didn't know Silicon Valley Bank was going to happen until literally 48 hours, 24 hours before it happened. And I was very proud of our team. We got together. I think we heard about it Thursday in the middle of the day that it was done. We were on the phone to that team by 5 o'clock, and we're trying to lift the whole team and bring it down to join us by the weekend. Took a little longer, but I was very proud of this. When you talk about culture, the ability to move quickly, see an opportunity, and in the face of what wasn't the greatest year for M&A, expand and move and get everybody on the same page. And I thought that was, we'll see.
That was Ken Mullis, Mullis & Co. Chairman, CEO, and founder, speaking with our Francie Lacqua in Davos. Meanwhile, you look at luxury stocks, they're on the rebound today, at least. Richemont, the owner of Cartier, today reported sales that beat analyst estimates. That's after peers like Burberry and Hugo Boss disappointed investors. So here with us now for a larger look at the luxury sector is John Edwards. John heads up Bloomberg's U.S. consumer coverage. So, John, can you tell us a little bit more about Richemont, which surprised everyone? Was it strength across the board?
No, the area that they were really strong in was jewelry. They're a big seller of high-end jewelry, and that was really where their strength was. One of their weak areas was watches, as it happens, which you might consider sort of a form of jewelry, but, much more complicated. And
I know, ask Arnold Schwarzenegger.
Exactly. And so we saw weakness there, and we saw that carry through into the report from Watches of Switzerland, the big Rolex retailer. And they did very poorly as consumers sort of pull back on those high-end watch sales.
Okay, so Richemont owns Van Cleef and Arpels, so maybe that's more the exception to what's going on. Mm-hmm. What did we hear from Hugo Boss and Burberry that gives rise to this idea that luxury is going to struggle at the end of 2023 and perhaps going forward?
Yeah, I think especially from Burberry, they were talking about just a general pullback in the sort of luxury consumer, that they're kind of running out of gas, and the sort of pullback that we've been waiting for is finally here. Now, I think some of that is going to be company specific. Burberry has come a long way from its days of huge licensing and having the tartan everywhere, but they are still trying to reposition themselves and move higher end, and they're not quite there yet. So I think it is going to be a bit of a tale of haves and have-nots in luxury, as opposed to just being able to say luxury in general is booming.
What about the structure of these companies? When we talk about kind of the conglomerate nature, particularly when it comes to LVMH, and the way they just sort of structure that, the idea that if one brand does poorly, another brand makes up for it, even though they're all kind of catering, in theory, to the same customer here. Does that work in an environment if overall there's less demand for luxury?
Yeah, that can certainly help. I think one thing, though, that we have to watch out for is areas, geographies that are struggling, and so we'll be watching, how the U.S. luxury consumer is holding up and how the Chinese consumer is holding up. Now, and we're seeing different signals there, too. I think that was an area where Burberry cited a lot of weakness, but Richemont said that they were still selling a lot of jewelry to those customers. So we'll see when the rest of the sector starts reporting.
And we know how much the China consumer plays into that.
Yeah.
On the U.S. side, though, there was a lot of anecdotal evidence, and I know here in the U.S. we don't have kind of a traditional publicly traded luxury maker the way you do over there.
Not quite the same.
Yeah, people talk about Tapestry and Capri, which to me isn't really luxury.
And Ralph Lauren.
Ralph Lauren.
Which has been pretty successful.
But Ralph Lauren, we talk about the strategy they've taken, at least some of their stores here in New York, I can't speak elsewhere. I mean, how much money are they making selling, coffee and pastries instead of, suits and skirts?
Yeah, no, there's certainly some of that. They've diversified a bit. But, I mean, I think, again, it's going to be, a lot of it's going to be very company specific, and we'll have to see how, Ralph Lauren holds up. They're going to report February 8th. We've got Hermes, which has been, just selling their high-end bags, like gangbusters.
Ridiculously priced scarves.
So we'll see how they do there the next day, February 9th. So, we're going to have some signals coming out, but I think it's this concept that actually Walmart, to speak of a non-luxury, to speak of a non-luxury name. Their marketing chief cited this concept called customized moderation, he called it, that their consumers are dealing in, where they're not pulling back everywhere, but they're pulling back selectively. So they are sort of customizing the way they moderate their spending. I think we'll see that in luxury as well.
Okay. All right. Well, that's a new one to me. John Edwards, by the way, nice suit. Is that Burberry?
It is not.
Hermes?
It's made to measure.
Made to measure, of course. Wouldn't expect anything less. On to John Edwards, who helped to lead our consumer coverage here on the U.S. side. A closer look at the luxury market worldwide, a topic we're going to stick on. After the break, we're going to focus on the luxury real estate market. Philip White, the president and CEO of Sotheby's International Realty, he'll be joining the program. This is The Close on Bloomberg.
Sotheby's International Realty is out with its luxury outlook report for 2024, following the real estate trends of what high-end earners are seeking in today's market. Joining us now with more is Philip White. He is president and CEO of Sotheby's International Realty. Philip, so good to speak with you. Before we get to your outlook and what you found, I'm just curious, given our conversation with John Edwards a few minutes ago about luxury retailers and some of the unevenness that they're seeing in their sales, I'm wondering from you whether you see any correlation between the slowdown in spending there on luxury goods with what you see in luxury real estate.
Well, thank you for having me. I think it's really kind of a different category. I mean, there's some correlation, but, high-end real estate, certainly tracks luxury to some extent. I think the slowdown in the luxury goods, watches, jewelry, et cetera, really emanates more from China than elsewhere. So, but I do, there's some similarities, but, really by and large, 2023, given all of the headwinds, was a relatively good year for the high-end real estate across the board. It certainly has regional and local implications, but we as a brand, Sotheby's International Realty, actually had a pretty strong year, although we were down year over year. But I think we beat the overall general real estate market, really driven by some large transactions. Our average sales price was one of the highest it's ever been, if not the highest. So I look at that very closely, and I do think there's some similarities, but there's some divergence as well.
One thing about 2023, of course, was that mortgage rates were high, and perhaps they'll fall in 2024, depending on what central banks do. But obviously, that translated into more all-cash transactions. What do those all-cash transactions do to the sales price? Does it have an effect on the sales price?
It can have an effect. It certainly is driven. All-cash offers are driven largely by opportunities in the marketplace, and that doesn't necessarily mean a discount on the price, but it can. But it's not unusual for the high end to operate with all cash offers. Many markets, the larger transactions are all cash. Even in New York City, some of the, the top co-op buildings, really require mainly cash to purchase a unit there.
Yeah.
The Hamptons, many markets are driven by cash offers.
Yeah, absolutely. I am curious, though, about maybe some of the shifting sands when it comes to where people are going. I mean, I'm sure you know this already, Philip. I don't have to tell you. The Hamptons are over, man. All the rich people, they're moved on. I mean, tell us where you're seeing kind of the most activity geographically. Is it in those traditional enclaves that we normally talk about, or have a lot of these folks sort of found new areas that appeal to them?
Yeah, I think that the traditional areas, Palm Beach, Jackson Hole, Aspen are still very popular. The other markets, that really come to mind, it's not a new market, but Nashville, Tennessee is really emerging as a major metropolitan market. Charlotte, North Carolina is becoming more of a tech hub. And then remote work is driving even locations that are not your typical location, to your point, like Charlotte, like Nashville, areas outside of Boston that are tech-driven, remote working, and even, the Silicon Valley, even parts of that, driven by AI, the emergence of that, the investment in that technology is going to spur remote working from those areas of Northern California.
We talk a lot here about kind of the money that comes into the U.S. real estate market from overseas folks. Are we seeing kind of the opposite of that? Well, meaning folks here in the U.S. who are looking for additional properties outside the U.S.?
Well, we do definitely see that. Some of that's driven by currency. Although the pound has strengthened of late, it was a bit weaker. That did attract American buyers as well as other buyers. Driven by, the euro. Portugal is always an attractive market particularly for Americans, but for other Europeans as well. So those are some of the top markets. Spain, Greece we're seeing a significant increase in luxury properties in Greece. That's really a testament to the stabilization of their economy and their government.
All right, Philip. Always great to catch up here. Philip White over at Sotheby's International Realty, the president and CEO. A closer look here at the luxury real estate market. All right, we're going to make a hard pivot from that and take a closer look right now at the space industry. Right now, we are going to check in. You're watching live pictures there of the SpaceX Falcon 9 rocket sitting there on the ground out there in NASA's Kennedy facility in Florida here, scheduled to lift off. And what's really different about this one this time, Scarlett, we should point out, this really isn't just about SpaceX. This is about Axiom, which is actually really the one operating this flight here. They've gone up a couple times here to the International Space Station, but every time they've done that has been with tourists, basically the rich people who pay to go on these flights. This time, they got real bona fide astronauts, scientists, physicists, that type of thing. They're from Italy, Sweden, Turkey. I think it's an all-European crew, I'm told, this time around. And they're going up there to do something.
Well, the aim is to visit outer space, but they're also going to be doing some research. Leading the journey for Axiom 3, that's the name of the mission, is Michael Lopez Alegria. He's a former NASA astronaut who now serves as a mission commander for Axiom Space. And Axiom Space is a Houston-based company that organized this trip along with SpaceX, which makes the rocket, and NASA, which is, of course, owned by the government and trying to shift away from being an operator.
Yeah, it'll be interesting to see how this needle gets threaded because, of course, we've seen private companies like SpaceX as well as some of the other ones like Blue Origin sort of really kind of hone into this market. And that was largely because NASA gave them kind of the clearance to do that. But the ultimate goal here isn't just to go to ISS or even to go to the moon. It's really to try to get us to other planets and potentially actually put a human foot on another planet for the first time.
Yeah, eventually we'll get there. But for now, the Axiom 3 crew will be going to the International Space Station. They're going to spend 14 days there working alongside the 7 astronauts that are already on the International Space Station. They're going to be doing some research, doing some experiments. So
the Falcon 9 launch was scheduled to launch yesterday. It is launching today, weather permitting. Let's listen in here as we count down to the launch.
8, 7, 6, 5, 4, 3, 2, 1. Ignition. Engine full power. And liftoff. Go Axiom 3.
further beyond, opening the door for more to follow. Godspeed, AX3.
Stage 1 propulsion is nominal.
Of course, if you are just joining us, this is the launch of the Axiom 3 launch to the International Space Station. Those incredible views on your screen, and there's our first shot of the AX3 crew inside Dragon on ascent. Now, in just a few seconds here, we should hear the call out that Falcon 9...
power and telemetry. Stage 1 throttle down.
There's that call out that Falcon 9's engines are throttling down to help us pass through the period of maximum dynamic pressure during ascent.
Max Q.
There's that call out for Max Q.
Falcon 9 is supersonic.
And that Falcon 9 is going faster than the speed of sound. Now, at this point, we will begin to throttle Falcon 9's engines back up.
Stage 1 throttle up.
There's that call out for mission control as well, as our AX3 crew continues on their way to space.
And we're watching right now the underside, or maybe that's the top side there of that Falcon 9 SpaceX rocket here, carrying that mission for Axiom Space of Houston, a takeoff from the Kennedy Space Center there in Florida. And this is significant in the sense that this is a crewed mission, and it's also a crewed mission with actual astronauts on this, not just space tourists here. So some real business here as they can make their way to the International Space Station.
Yeah, a 4-person crew, and all European crew as well. And of course, after reaching space, the Crew Dragon capsule will break away from the Falcon 9 rocket. And
yeah, let's get to Ed Ludlow, who's joining us right now. Ed has been covering the space industry for us here. And Ed, maybe you kind of walk us through what we're seeing right now. The picture's a little blurry, but give us a sense of what we should expect over the next few minutes.
Yeah, so in about 20 seconds' time, the first stage, the Falcon 9 booster, will separate from the second stage, which is the smaller rocket to all intents and purposes, carrying the Dragon capsule that is home to the crew for the time being. That Dragon capsule that the crew are sitting in is the same that flew in the AX-1 mission, the first Axiom mission, AX-2 mission, in May of last year. So it's seen some duration. And there you go, there's that stage separation that you're seeing on your screens right now. And so for the time being, the Dragon atop the second stage continues on its trajectory. But I love how you guys set this up. I mean, the significance here is this is really the public sector handing the baton to the private sector. SpaceX is like the airline, the flight operator, and Axiom is like the travel agent that's going to do the booking. And it definitely represents a pullback from NASA, European Space Agency, and others in taking the burden of getting humans into low Earth orbit.
This was supposed to take off yesterday. Do we know what delayed the mission?
Yeah, technicals, just more time needed to run mission controls. The weather was actually a factor. We're all going as planned. It is nominal, as they say. But when you have a instantaneous launch window like this, the timing has to be very precise because it relates to the trajectory that the spacecraft is going to get to reach a specific orbital path to line it up with the International Space Station.
Yeah.
If there's any risk that you can't go at that exact time, you go to the backup window, of which there are several.
One thing that's interesting when we mentioned this is all European flight, and I think on one of the other Axiom flights, they did have a couple of astronauts, including from Saudi Arabia. I mean, space travel, as you know, Ed, for a long period of time has really been dominated by 2 or 3 countries, primarily the U.S., I guess maybe Russia, and to a certain extent India here. Are we going to start to see a much more of an expansion of the nations that are participating in this space exploration, and more importantly, whatever the end goal of all this is supposed to be?
It's why Axiom is interesting. You know, we're billing this as the first all-European commercial crew to go to the space station. There are different ways of looking at that. Either that this is progress for Europe's space efforts, or that Europe is wholly beholden to the only game in town, which is SpaceX, you know, America's crown in the jewel in the space crown. You know, the European Space Agency with its own launch systems has really struggled. But, you know, Axiom, look at where they've raised money from. They did a $350 million Series C last summer. That money came from firms in Saudi Arabia and in Korea. So, again, it's kind of a global private sector story, but there's still a high concentration of U.S. leadership, given that SpaceX is pretty much the only option right now for regular cadence of flight to the ISS.
And tell us a little bit more about Axiom and how it charges essentially interested travelers, interested astronauts, amateur astronauts
Yes.
to go to space?
Yeah, so essentially it charges per seat to private astronauts. In this case, these are highly qualified associates and personnel of different European space agencies and air forces. They have some tourism ambitions where high net worth individuals can do the same. And, you know, the point of flagging their incredibly large Series C fundraise last summer is that they're not yet meaningfully revenue generating. But their future ambitions are very different.
Yeah.
Remember that the long-term plan is to decommission ISS, which is run by NASA and Western partners. Axiom hopes to fill that void and is currently working on a private space station that it will put into orbit in parts starting in 2026.
Yeah, in conversation right now with Ed Ludlow. He's going to be sticking with us here as we continue to watch here the launch of that latest SpaceX rocket, now making its way toward the International Space Station, where it will dock there with 4 astronauts. I want to bring George Ferguson into this conversation. He's a senior aerospace analyst for us at Bloomberg Intelligence. And George, we've been talking a lot over the last few years about how much of space travel have shifted away from the official government agencies like a NASA to some of these private companies here. Are we going to see more companies involved in this than just the small handful that we have right now?
Yeah, I think we will, right? I think this is part of the democratization of space, right? And so I think you get more minds involved, you get more folks thinking about ways to bring down the cost, how to improve the safety. I think it's all a huge positive, for all of our efforts in space, whether it's for tourism, but also for manufacturing and exploration. I think there's a lot of opportunity. A lot of companies see it that way. So yes, I think you'll see a lot more commercialization, other companies interested in this.
And once this crew reaches the International Space Station, they're going to be doing some work, some experiments, come back with some research. But as Ed was telling us, over time, the idea is that the ISS will be retired and there will be private space stations. What kind of timeline are we talking about there?
Actually, let's listen in right now. We're actually starting to see that booster land back down. Let's listen in right now to that broadcast.
And if you couldn't tell by the loud cheers, we did
Stage 2 STS is saved.
We did stick that landing. Falcon 9 has landed once again. But turning our attention back to the crew, as you see there, our next event is second engine cutoff. Or SECO, as it's
and Scarlett, I mean, we saw there, of course, this has always been the big selling point with SpaceX, right? The idea of reusable boosters, and you see sticking that landing. Remember how many sort of fits and starts they had to get that sort of right. And they've now gotten it right very consistently here. And this is really a marvel to see something of that power and that nature that in the past would just, of course, be blown up or just left to just sort of die in the ocean somewhere, come back down, be fixed back up, and presumably to be used once again.
It's a picture-perfect landing, and it's what SpaceX had intended all along. George, I want to bring you back into the conversation because we had to cut you off a little bit there, but tell us a little bit about the plan here to wind down the ISS and replace it with private space stations.
Yeah, so I mean, recently it was announced, I think it was the last couple of days, right, that the space station would be retired in 2031. And again, I think, the way you think about it when you're a government, agency like NASA, you'd rather spend your money on the cutting edge part of space exploration. And as processes like moving people into orbit, moving supplies into orbit, orbiting the Earth become more commonplace, you'd rather push that to the private sector. I think they're more innovative. They'll push costs out, and they'll work on reliability. And you can spend your money on the cutting edge.
I just want to go back to Ed Ludlow, who's still with us here, co-host of Bloomberg Technology. And Ed, you saw that booster land back down, sticking the landing, as the narrator, of course, said. It was a picture-perfect landing. And maybe you just give some context here, just how far along we've come in this process to make sure that we can have these rockets and reuse them.
Well, in the context of Falcon 9, this is landing number 248 after launch 290. And that's why I say, for the time being, SpaceX the only game in town, because there is no private or public sector-backed operator launching with the same cadence. The economics in terms of the money behind this, SpaceX charges about $55 million per human in each seat. So they've just got it to such a click on the reusability that they're making money on this, and we've reported out some of those financials. But that's the way the efficiencies come.
All right, Ed Ludlow, co-host of Bloomberg Technology. George Ferguson leads our coverage over at Bloomberg Intelligence. A look at the latest SpaceX launch here as we wait for it to dock at the International Space Station.